Questions about whether or not central banks are kind of flexible enough and liquid enough to actually make that kind of gut reaction, especially when it comes around the geopolitics, when it comes around the wage data. That's the theme you're seeing in the corporate space as well.
Yeah, absolutely. So plenty of things to digest. And on the corporate story, Kriti, as you mentioned, we've got plenty of corporates that could be on the move this morning. The likes of IAG, Man Group, London Stock Exchange Group, Haleon. We've talked to the management of many of these businesses. Some of those conversations still to come. We will look for movement there. Osram also could be in focus as a result of the cancellation of a project there in the lighting space, so we'll certainly be watching that. So plenty of individual corporate names to watch out for. And back to the macro, we've got that Spanish CPI print, Kriti.
Yeah, just a little bit higher coming in for the preliminary February numbers, coming in about 2.9% year over year. The estimate there was 2.8%. I should mention, though, from a macro perspective, you're not necessarily seeing much kind of a move in the euro right now, 108.33, but it is still a slight uptick, and we have seen that in the Spanish data before.
Yeah, absolutely. And worth pointing out, I suppose, that Spain wasn't really ever the source of all of the inflation drama that we were seeing in Europe. There were other parts of the Eurozone where we saw inflation jumping a lot more further east, certainly. Yeah. But nonetheless, important to keep an eye on all of these things. In terms of the stock story then, we are just opening up across these European equity markets. And in terms of where we are, the UK market up by around 0.2%. So is the CAC 40 over in Paris. So overall, we're up by around 0.2. The DAX in Germany yet to open, but we do have a gentle upside, I suppose you might say. But US futures are pointing a little bit lower, giving markets a moment to settle down. But in terms of the sector picture, real estate does seem to be one of the best performers then, Kriti, up by just over 1% in the real estate sector this morning.
Yeah, you're also seeing a little bit of a commodities move here. When you look at the index contribution, again, it is still early, about a minute and a half, about 90 seconds into the open, so all this is still going to shake out here. But you are seeing the likes of Rio Tinto, for example, Glencore, for example, also contributing more to the upside. Even IAG coming up here higher by 2.2% in that initial trading, 2.5% now. One of your biggest drops, though, coming, of course, from the London Stock Exchange, down 1.4%. That buyback announcement that they actually said back in November, perhaps not creating the lift that maybe they thought they would.
Yeah, and I was just looking at other things on the downside. And Amadeus, which is linked to the travel sector, that stock is down by just over 5% this morning. So there is something else to focus on there. It seems like some of these stocks that we are looking for movement on might be taking a moment to open up. But there we go. Rio Tinto, to your point about basic resources, Kriti is on the upside, as is Glencore. Richemont in the luxury space also moving higher. We had Joe Easton a moment ago telling us to look out for AB InBev, and certainly that is one of the movers. That stock down by 1% or so. And some weakness in tech there again with ASML.
Well, I think the AB InBev story is so important. I think it really needs to be underlined here, because when you do look at some of the numbers that are coming out, look, their revenue missed, their volumes missed, the consensus expectations, but their guidance actually came in line. And one of the questions was, does that wage contract that overnight came out with the Teamsters Union, a 5-year contract, wages up 23%, is that viewed as a positive, given that was an overhang for the stock, or a negative? And now it looks like it's a little bit of a negative, which, by the way, I have to mention, this was the Teamsters Union that was also behind the UPS big strike as well. And it was a similar dynamic. In UPS earnings, they were flying high. They didn't end up meeting their revenue story. And then the wage contract ended up eating more into their margins, and UPS stock suffered. I understand two completely different industries, but I wonder if a similar dynamic.
As we look for cracks in labour markets in certain places, not because we want to see them, but that would reinforce what central banks are expecting to see, at least. And as we look for those cracks, it's interesting that we still see Labour having quite as much power and influence as it does then, Chrissy, at this stage of the cycle. That takes us quite nicely, actually, into our next conversation. US resilience, the US economic resilience story has been a feature of markets over the past year or so that perhaps has caught a number of people off on the wrong foot. How special is the United States? How special is the dollar? Certainly part of the conversation as well. We heard from TD's Mark McCormick on the FX side on this subject. Let's have a listen.
This is where I think everyone's been wrong. Everyone's been focused only on U.S. exceptionalism. Everything is participating at the same time. So last year we went through a wave of U.S. looks great, China and Europe are underperforming. At one point, China and Europe look great, the U.S. is underperforming. What we're seeing for the first time is all three regions are firing in the same direction. And that is positive for global growth dynamics, it's positive for equities. So that's good for sterling, it's good for euro.
Okay, a conversation then starts on US exceptionalism when it comes to FX markets. Let's get into that now. Meera Chandan joins us, co-head of Global FX Strategy at JP Morgan. Meera, thanks so much for joining us. We just heard there those comments around how people maybe have got it wrong. People have been too focused on US exceptionalism. That's obviously been something that has driven the dollar nicely. Do you see any change to that?
Well, I actually, in part, agree with the comments that we had earlier. For a change, we are seeing an uptick in global growth dynamics. It's a fairly synchronized manner. Obviously, the starting level for the U.S. is just substantially stronger. We had the U.S. grow by just about 5% annualized pace in the third quarter of last year, above 3% in the fourth quarter, while Europe was in recession, or at least, sorry, flirting with recession. I think... yes, it's an improvement that we've seen an increase in PMIs. We're inching closer to a positive territory on growth, but at the end of the day, growth is still tracking about half of what the ECB is projecting. And let's not forget that U.S. exceptionalism on certain aspects is just not going to fade. If you look at relative earnings surprises, it's been stronger in the U.S. If you look at U.S. yields, the projection for where they're going to be at the end of the year, the U.S. is still going to be yielding more than 40% of the currencies globally. And let's not forget that, yes, if it were only for the growth uptick, I think that would be more dollar bearish, but let's not forget there's the U.S. elections in the pipeline, and there's certain policy actions that could come across from there that actually could give the dollar a lift as well. So this growth uptick you're seeing could actually prove to be quite short-lived, I think.
Okay, so I was going to ask, so yes, if we are trading around a growth uptick, and if that goes global, where does that leave emerging markets? Because an interesting other side of the dollar exceptionalism story has been where that leaves EM, and I think you've got some positive views on some emerging market currencies.
Yeah, I think, look, that would be a pretty good environment for emerging markets and for any cyclical currencies and assets in general. But I think we also have to keep in mind, that not all currencies are the same. The big theme in FX for the last 18 months has been that the highest yielding currencies, where carry is quite large, have been outperforming. And I think if you look ahead into 24, the most important theme is going to be that we're going to get a substantial amount of yield compression because central banks, 70 or 80% of central banks will be cutting rates. So that means there are going to be several high-yielding currencies in EM that are going to be losing, coming out of favor. And I think they're going to get a chance for some of these lower-yielding EMs and, frankly, in G10 to actually outperform. So I think you can't really paint it all with a strong brush, but if the growth picture, if it were only the growth picture that mattered, I would agree that it should be a pretty good environment. But the problem is you're going to have several hiccups to that growth outlook, depending on what kind of policies are put into place after the U.S. elections as well. So,
well, let's talk about those policies, because not just the U.S. election, it's the U.K. election as well.
Yeah.
And I believe there was actually an exclusive overnight by Bloomberg that suggested they're actually trying to coordinate the timing of those two elections to avoid more geopolitical risk. You're talking about policies that would create that uptick in growth. What kind of policies are we talking about?
Yeah, I think UK elections less relevant for FX at this point, but for the US in particular, I would say the tariffs are probably the #1 issue to focus on. And if you take a look at the Bloomberg news count, for example, around tariffs, that's gone up quite substantially as well in recent weeks. And the transmission mechanism is the following: when tariffs are imposed, say by the US on other countries, we saw this with China, the currency of that country will weaken to offset the competitive disadvantage it puts it at. And that weakening, if it's 10% tariffs, is about 50 to 60% of that tariff, so about 5 or 6% strengthening in the dollar if 10% tariffs are imposed. And I think that is going to be the key, one of the key factors that you should be focused on, depending on which candidate is the front runner. But if tariffs are a serious policy option here, it's really going to firstly prevent the market from engaging in any kind of dollar weakness in response to the growth pickup we've had. Because it's gonna take off growth.
Does that work in reverse, though? That if you start to see reciprocal tariffs, for example, if the U.S. puts more tariffs on the EU and the EU does it in reverse, does that then benefit the euro or the pound?
Well, I think first and foremost, the volumes kind of would impact the dollar first and foremost. And let's not forget, if we get into this tariff tit for tat kind of approach, that's going to be a massive hit to global growth. So this excitement that we have about the upturn in global growth metrics is going to prove to be quite short-lived. So that brings you back to a period of dollar strength, because it's going to be bad for risk sentiment, good for the dollar.
How does that period of dollar strength rub up against a resurgent yen this morning? We're up by 0.6%. And obviously this is being driven by Takata at the BOJ, a board member there, talking about how close we are to change in policy. The case for ending negative interest rate policy is gaining momentum, apparently, because he was saying that the price target is finally coming into sight. How do you interpret then, Mira, these comments?
Yeah, the market, and we have been waiting for the BOJ for a long time. I think, at some point they're going to have to shift policy. Everybody agrees on that. There is a bit of a debate on whether that happens in April or mid-year. We're leaning towards mid-year. But at the end of the day, for dollar yen, what matters is not so much what the BOJ is doing. If the BOJ is moving by 10 or 25 basis points, that's not going to move the needle on dollar yen.
But would it be so weird, the timing, if they were doing that just at the time that we see the Fed and other central banks cutting?
Yeah, it would help, but the 100 basis point move is coming from the Fed, so so dollar yen, we are looking for a retracement lower, but this is not going to be massive amounts. Probably the low 140s to mid 140s is a reasonable landing point, because at the end of the day, even with the rate hike, the Fed, the yen is going to end up as a 0% currency, even by the end of the year, with the U.S. potentially at 4.5.
Okay, so we got some numbers on the yen. Quick numbers on euro dollar and cable.
Euro dollar, is 103 to 105 on the expectation of U.S. exceptionalism persisting. And the prospect of potential tariffs. Our cable follows a suit in terms of magnitude.
And this is over a 12-month time frame?
I would say in the first half of over the next couple of quarters.
All right. Mira Chandan, co-head of Global FX Strategy over at JP Morgan, giving us a little bit of everything this morning. We thank you so much for joining the program. Let's go from FX to the stock picture and get some of the individual stocks on the move. Joe Easton is all over that from our equities team. Joe?
So here's the two airline stocks reporting today. IAG actually just ticking slightly lower now, but pretty much unchanged. Pretty solid numbers out of the British Airways owner. The passenger volumes holding up strong. But Air France down 10% at the moment, on track for the lowest close in more than 3 decades, according to Bloomberg data. It's a cost issue there. France disruption in terms of industrial action in Paris is hitting them, but also a wage increase for KLM pilots as well. That's what analysts are pointing to in terms of the decline in earnings. A bad day for that one. Then we'll move over and have a look at a couple of other earnings. There's plenty out today, plenty of movers. AB InBev down once again. Now, volumes actually did miss on expectations, but they have come down a lot given the fallout of the Bud Light influencer scandal that's been covered a lot. So that one ticking even lower today. And you were speaking to Haleon earlier, up 6%, a decent gain for that one. Bear in mind the whole sector fell yesterday after the weak numbers from Reckitt Benckiser, so that might be helping, having lowered expectations coming into those numbers. And Ocado in London, 2 stories there. The margin slightly better in the food business, but what was actually weak is the robotic warehouses not doing as well as expected, but the market seems to be ignoring that line at the moment, gaining almost 6%. And London Stock Exchange coming down. The equities business is weak, but as you were explaining earlier, the data business is the main bulk of the business, but perhaps the equity side is weighing on that stock today, so it's down 1% at the moment, 1.7%, a bit lower at the moment. Then we'll look at a couple of other stocks. There's some big movers on this one. You mentioned in the build-up, AMS Osram is getting even worse as I continue to talk, down 42%. A contract cancelled. Analysts suspect it was Apple. They're writing down around 900 million euros worth of that value. That's a heavy loss. You won't be surprised to hear that's the worst on record for that one. Grifols, the short seller target, doing a capital markets day today, not doing enough to reassure investors following the Gotham City report. And Ikestron over in semiconductor manufacturing machinery, down 17% for that one. Weakness following worries around some other firms in that space recently. And the last on the consumer stocks, Beiersdorf, the owner of Nivea skin cream, some weak margins from them today in Germany, down 3.9%. Then just a couple of morning calls to bring you Direct Line, a massive jump for that one yesterday as they get a takeover bid from a Belgian rival. But that one today is raised to neutral at Barclays. They no longer recommend selling, up another 0.5% today. Meanwhile, Bayer, this one is downgraded today over at Citi, who says an IPO of the company's crop unit is unlikely due to the macroeconomic deterioration, and Bayer coming down 0.7% this morning.
Thanks so much, Joe. Joe Eason from our equities team joining us there. Coming up, we'll be back to AI themes. The world's biggest supplier to the automotive sector announces an AI partnership with Microsoft. Could this make for safer driving? That is certainly what both parties to that deal would hope for. We'll be hearing from the Bosch CEO shortly. This is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because this is really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see you've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Bloomberg.
Why while we cannot predict when is the next cycle, what I can tell you right now with precision is AI is changing how we interact and how we use our phones. And if consumers feel that they need to have an AI phone, that will create this new growth momentum for the industry.
Qualcomm CEO Cristiano Anon there speaking to Bloomberg. And sticking with the AI story, German industrial giant Bosch teaming up with Microsoft to put generative AI into cars. Bosch is the world's biggest supplier of car parts to the auto industry, and the announcement is the latest from a sector racing to both electrify and digitize. For more, let's get to Bloomberg's Oliver Crook in Berlin.
That's right, Critty. And we're joined now by the Bosch CEO and chairman. And while they are the biggest, supplier to the auto industry in the world, they also are in 1 in 2 smartphones across the world. They're, of course, in many households. Maybe you have a Bosch drill at home, which is used frequently into productive use. And so we're very pleased to be joined by the CEO and chairman to talk about all things AI to the consumer. So listen, you just announced this partnership teaming up with Microsoft in AI. How is that going to change my experience of driving a car?
Well, the good thing is that Microsoft has brought a lot of work of generative AI to us. And generative AI is now possible to not only see objects and analyze what actually is in front of the road for the car in terms of there's a tree, there's a bicycle, there's another car, but it now can actually interpret what the scene is all about. So are we talking about a dangerous situation? Are we talking about a situation which is critical? So see something like a ball coming around, so the movie is actually already playing in the car that after the ball probably comes a kid, and with a kid there's a risk of an accident. And that's a new thing where we can interpret now scenes and semantics and not just objects.
And you sit really at the center of this question of technology and industry, software and hardware. I'm wondering what your reaction was to the news that Apple has abandoned their plan for an EV. You know the unique challenges that exist between these two things. Does it make any difference also for the auto industry?
No, the auto industry welcomes always new players, and we have seen so many in the recent years, right? Think about all the new players that came from China. So it's actually a good signal if somebody wants to come into the car industry. On the other hand, we also saw that some players also then decided not to do it, because you can, as we, for example, would never go into the car industry and build vehicles, right? Because we think for us as a company, it's better to bring technology to the automotive industry. But everybody has to make his decision, and definitely it's a big industry and it's a big of effort if you go into vehicle production. So anything is understandable, entering, not entering, also exiting, you will see it all.
But what you do, obviously, is supply the auto industry, an industry that is in the midst of a huge transition, the timeline of which I think has shifted substantially in the last 12 months. With the slow adoption of EVs, how much has that changed in the last 12 months, and how does it bear on your strategy?
Well, we love everybody who makes cars, right? We try to serve really everybody who makes cars. And obviously, we are monitoring very carefully what's not happening, because in the end, the consumer decides. And the consumer is influenced by many things right now. It's influenced by the interest rates. It's influenced by the general economic mood and by emotions, because you're not buying as a consumer for a reason that you need to buy something. You're buying because you want to buy something. So currently, you see, we had the first wave of fully electrified cars, lots of them sponsored by governments. And now, obviously, we have this wave like going forward. So there is now a phase where probably it's not growing that fast anymore on the electrical side. But still, over the next year and the year after, probably we see growth coming in, and also in the fully electric ones. It's a thing which is moving, and that's very much influenced by the markets of consumers.
And we talk about growth, and we talk about a challenging year in 2024, and I think a year probably for Bosch, and for many companies, it's going to be concentrated more on cost efficiency than growth. Where is the weakness concentrated, A, geographically, but also within your units?
Well, all over the world, we see now a kind of constant demand situation, which is normally for a growth-oriented company not the best place to be. We will still grow in 2024, but it requires a lot of adjustments, because the estimate for 2024 was more optimistic than we now see it. And that means to stay competitive, we need to adjust some structures here and there, and that's what we do. It's not a giant amount, but we have to do it in various small units and different locations. That's what we announced. We have to do it in home appliance. We have to do it also in the automotive side. We have to do it in back office operations, even in R&D and development. Some of our estimates were more bold than actually now 24 and 5 look. 25, hopefully we see things coming back up. But then also we wave on another technology. So things have to be more productive in 25 than they are now.
And I want to know more specifically, what is your experience now of the Chinese economy and demand in China?
Well, China will see a relative very small growth in consumption of cars. Bit more electrical cars, so electrical against ICE cars will come. More plug-ins and more range extenders will come, and the export will grow on the automotive side. In general, the economy, you know, is not growing as fast as it was anticipated some years ago. So we're talking about a lower growth number. And that's what we feel specifically also in the home appliance business, also in the construction-related business, because you all know the construction business and the real estate business in China is in a trough.
And in China specifically, obviously Bosch is so critical to the ecosystem of internal combustion engines, and you're also obviously trying to get to the same level with battery electric vehicles. But there's also a moment now where there's more protectionism, and we've seen a lot of the Chinese auto companies trying to be more doing things in-house. Are you as well integrated in the Chinese BEV ecosystem?
Well, we love our Chinese customers. We are pretty much working with every Chinese OEM and with every customer in China. It's a great work because they're fast, they're challenging, they do great technology, and this is something where we also focus a lot on really riding the wave towards fully electric cars. That's what we do. Our large volume electric car business happens in China, and there also we are in a positive mood to further extend this because the percentage of cars which use this technology will grow.
And we're talking about also semiconductors, because this is yet another business that you're very, very active in. And obviously, the EU wants to hit 20% of production within the bloc in 5 years, basically.
Yeah.
Is that possible? ASML says no. And if not, then how do you get there?
Well, if ASML says no, then obviously we have a very strong knowing player saying something. Well, I'm a bit more hesitant about targets set by politicians towards markets, right? There I'm very careful because in the end, the world global market has to decide how much percentage is brought from the Europeans to the table. On the other hand, the good thing is we see now investments into semiconductor industry. It needs and requires government money. You see that in the US, you see that in Europe, you see it in Asia. So that's actually a good mood. Yeah. If it will reach 20%, to be honest, that's not so important. Important is that things go online, things come there, capacity is unlocked and actually working.
And very quickly, is Germany the sick man of Europe? We have a lot of different executives telling us a lot of different things. What is your appraisal of the German economy, quickly? Well,
the German economy has to come back. There are some things the Germans have to suffer through because it's coming from the global situation. But some things the Germans have now to act and have to think what they should do on the educational system, infrastructure, and obviously they have to solve some other issues which come around, which is like defense and so on. So Germany has to get their act together and walk and go. And then I'm very optimistic because in the end, it's still a great place to be.
Indeed. Thank you so much, Stefan Hartung, the CEO and chairman of Bosch. Anna, back to you in London.
Thank you very much. Bloomberg's Oliver Crook with that interesting conversation with the Bosch CEO. So pretty. Germany needs to get its act together, but it's still a great place to be. That's one of the interesting conversation today on the future of AI and what it does for that particular industry. We go from suppliers to the auto sector to the aviation sector next. Guy has left us to go and talk to IAG. We're going to be having a conversation about that. IAG saying they're not worried about uncertainty over aircraft orders around the Boeing MAX 10, but lots of other subjects to discuss.
Plenty, and it's coming on a day when we have numbers coming out of Air France as well, where they're saying, look, the same thing as IAG, that travel demand is still intact, but they are still dealing with hits when it comes to wages, when it comes to contracts, and when it comes to that geopolitical uncertainty. I wonder what IAG has to say.
Yeah, the IAG share price only down by 1.4% in a market that's up a little bit this morning, but that's not bad compared to the Air France KLM move we saw out the gates this morning. Yeah. So we'll be sticking with that theme. Don't miss our interview with Luis Gallego, the CEO of British Airways owner IAG. That conversation is coming up shortly. They'll get into, no doubt, the cost base, the pricing power that this sector has, and of course, machinery delivery. All of that in focus. This is Bloomberg.
You think New York is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime, but we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or you're advising?
Yeah, the mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Markets Today. We're about 30 minutes into the European trading day. If you were to look just at the surface, it wouldn't seem like there's much going on, but I promise you there is. You're looking at a FTSE 100 that's higher by 0.2%, a Stock 600 that's higher by the same margin. On the surface, it seems like it's a macro day, but let me tell you, there are plenty of earnings stories. Anna, we've been talking about this all morning long. Earnings stories that are coming in on par with meeting expectations. That's a good thing in this growth environment when everyone's expecting for some sort of slowdown. We're not seeing it just yet.
Yeah, really interesting. Although there are some standout stories that are sort of going their own way, aren't there? Yes. And there's a couple of those I thought I might just mention here. One of them is AMS Osram. And this one we've been tracking because of the negativity in the share price reaction today to the cancellation of a contract. And the market is alive. We've talked about what that could be. We've had some analysts suggesting it could be related to Apple. We had multiple reports, including from TrendForce last year, that was saying that the rollout of the micro LED Apple Watch, that was linked to AMS Osram, or that was a supply chain to watch. And so there could be a link there. But that's where the focus is in terms of that particular share price. And then we spoke to the Haleon boss a little earlier, didn't we, Critty, which is interesting. And Joe Easton making the point that perhaps it was the negativity around the sector yesterday with Reckitt Benckiser so disappointing that maybe gave them an easier job to impress today. But Haleon's certainly doing okay this morning.
And one of the ones that perhaps aren't doing as okay this morning, and we'll talk about that, we also spoke to the LSE Group CEO, London Stock Exchange. It's one of your biggest index weights on the FTSE 100 this morning, down about 2.3% when you're looking at some of these moves. Look, the earnings came in just in line. The buybacks were exactly what they'd said they would be back in November. They didn't give you a ton to really work with there, and yet the market isn't super happy with the results. I'm curious what they're actually responding to. That's one piece of the equation. The other major mover to the downside is in the travel sector. Air France down almost 10% this morning. Their guidance coming in a little bit positive, but when you look at some of their actual numbers, they are quite weak. They're talking about an operating loss of 56 million euros when the estimate was a profit of 140 million. A lot of that coming from geopolitical uncertainty and, of course, the employment story as well.
Yeah, absolutely. Interesting on the demand story. IAG saying they see demand continuing to be robust. So let's focus in on the aviation sector now. Guy has disappeared to another part of the city of London for a conversation with the IAG CEO. Guy.
Thanks, Alec. Yeah, I've beaten my way across the city of London. I'm now joined here by Luis Gallego. He is the CEO of IAG. The market reaction fairly mixed this morning in terms of what we're seeing to your numbers. The numbers look pretty much in line with expectations. Looks like the fourth quarter, you've seen a little bit of an acceleration. You're painting a positive picture going forward into 2024. What gives you confidence, given the uncertainty that we're seeing at the moment, to kind of paint that picture, to talk about what you see in 2024?
Good morning. So, yes, I think we had very good results in 2023. We had a very strong leisure demand that we see that it continues during 2024. And also we see the recovery of the corporate traffic. When we see the health position for the second quarter and the third quarter is positive. Even the health yields that we have are above the health yields that we had last year. So because of all of that, we are positive about the year.
In terms of what you're watching, geopolitical risk, that looks like it's impacted North America. You've got a cost story, you've got a labor story that you're managing as well. Is top line going to be strong enough? Is demand going to be strong enough to continue to compensate for all of those factors that are going to maybe make life a little bit tougher?
Yes, I think so, because we have a transformation program that is delivering results. So, for example, last year we reduced our non-fuel costs by 4.5%. We increased our unit revenue also. So we continue with a positive trend in demand, as I said before, but also we continue with a transformation plan that is going to help us to manage this inflationary environment that we have. And when we see also the forecast for the fuel price, we see a stable scenario.
You talk about investing in the business. We're not going to get a dividend yet. Do you have any kind of clues that you can give me as to when that dividend might arrive? Because the picture at the moment seems to be that you're making cash, you're making money, and you are investing that back into the business. Is there any pressure from shareholders to return some of that to them, or are they comfortable with the idea that you are investing what you have back into the business, as you say, potentially to drive future returns?
I think shareholders, they know that we are generating an important amount of free cash flow. Last year, 1.3 billion euros. And what we are saying is that this year, even with the investment that we are doing, we are going to continue generating a huge amount of free cash flow. And what we have said is that if everything continues as it is, we will give dividends soon.
Yeah, but the priority at the moment is investing back into the business.
I think we have two priorities: to invest in the business and to generate the cash flows that are needed after the capex that we are investing.
In terms of what the summer season is going to look like, how much visibility do you have right now? How sort of confident are you in terms of what behavior is going to be both on the corporate and on the consumer side?
So corporate traffic is coming back. It's true that we are still in levels of 70% in volume if we compare with 2019. But when we see the yields, last year revenues were like 10 points above the volume. So if the volume was 70%, the revenues were 80%. But now, the first weeks of the year, we see even higher yields in corporate traffic. So volume is coming back, but also yields are higher. And because of that, we can offset the lack of corporate traffic with very strong premium leisure demand, and that's the reason of the results.
Okay. One area, I'm just looking through the numbers briefly this morning, one area that looks like it's a little softer than I would have anticipated is maybe North America. You flagged that that's potentially a Middle East factor. Is that changing? Has that changed? When are you going to return to Israel? Is that something that is a legacy of last year? Is it continuing into this year?
So in the last quarter and the first quarter of 2024, we see the impact of the Middle East conflict because all this started in October, and we saw that mainly corporate traffic was affected. The leisure traffic not so strong. Point of sale, US mainly. We don't see that anymore in the second quarter and the third quarter. We are considering now to come back to Israel. British Airways is considering to fly from April. Iberia Express, they are going to fly since the 1st of April. Vueling, they are considering to fly there in June.
You got MAX 10 orders coming through from Boeing, or at least we think you've got MAX 10 orders coming through from Boeing. What's your view of what's happening at Boeing right now? Are you confident you're going to get those airplanes? Are you looking at options? How are you going to manage that fleet story?
Well, first of all, we are working very closely with Boeing to try to see the program that they have in place in order to improve the quality of the aircraft. We are confident that they will achieve it. And then we have 25 Dash 8 200 that are going to be delivered starting in 2025. And the Dash 10, still the certification is pending, but even in the case there is a delay because they need to use the resources for other areas of the company, we have the flexibility to move these variants to others.
Do you think that is now likely, and will that affect capacity?
No, for the time being, the capacity that we have in our plans is not affected for this situation. Also, we don't have the Dash 9, that is the aircraft that had the incident in Alaska.
Do you think your passengers are comfortable with the airplane? Are you comfortable with Boeing as a supplier?
We are comfortable. I assure they need to work harder and to improve the situation, but we have a Boeing product flying in the group for a long time ago, and we know that they can manage the situation.
Are you comfortable with the fleet as it is right now? Do you think, are there any obvious gaps that you think you're going to need to correct?
No, we don't see any gap.
Okay, so no new aircraft orders coming through. In terms of how you see the macro picture developing over the course of the next year, just walk me through that. We're all very much focused today on what the inflation picture is going to look like. Do you get a sense, the aviation industry feels like it's right at the center of this consumer story right now. Everybody's still revenge traveling. They want to go out to restaurants. They want to fly. They want to go on holiday. Is that as we continue to digest the post-pandemic world, is this something that is going to change? Are services? Do you think service inflation is going to remain sticky for a while?
I think we are having this debate since 2 years ago. But the reality is
that it hasn't changed.
No, and that's true. So the priority now is to have experiences. So there are other areas where we see that the people they are not buying some goods, but it's not affecting us in the same way it's affecting others. So the leisure demand is still very strong. Premium leisure demand continues very strong. Corporate traffic coming back. It's true that some type of trips that we had in the past, like day trips, are not coming back, or trips where you only spend one night at the destination are not coming back. But in general, we see that this year corporate traffic is coming back in parallel with the growth in capacity.
But you're not seeing any price pushback. You're not seeing any pushback from consumers on elevated prices. Prices that the consumers are prepared to accept those kinds of prices. There's no kind of shift in that narrative.
But what we see is that the prices we are offering are in line with the inflation we are having. So you can see that we are not doing something very different to other sectors. So I think the customer at the end, they want to fly, and the market determines the prices.
And they're going to continue to do so. It's always great to see you. Thank you very much indeed for sharing some of your time with us this morning. Luis Gallego, the CEO of IAG. Kriti, back to you.
All right, Bloomberg's Guy Johnson, as he mentioned, the CEO of IAG, which of course is the parent company of British Airways. We thank you so much for bringing that interview to us. And he's talking about this resilient consumer. Does it then show up in some of the inflation data as well? Coming up, that's where we go next. We're going to have a barrage of Euro area inflation data coming up. We're going to discuss what the numbers could mean for the ECB. Our chief European economist, Jamie Rush, joining us next. Stick with us. This is Bloomberg.
venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Markets Today. We're 44 minutes into a European trading day that actually has a bit more upside than perhaps we were anticipating, a bit of transatlantic divergence as well as we wait for inflation data on both sides of the Atlantic. European stocks going a little higher this morning. London is up by around 0.25%, overall up by 0.3% on European stocks. US futures, though, suggest we could see a little bit of weakness, down 0.25% on NASDAQ futures right now. So inflation data is front and center when it comes to macro themes today. French inflation has eased to its weakest level since September 2021, but data from Spain showed core inflation slowing less than expected. Bloomberg's chief European economist, Jamie Rush, joins us now to break down what we need to know here. Jamie, good morning to you. We've got PCE out of the US coming up later on. That's going to be a bit of a focus for the week. But sticking with the European themes, break down the latest trend that we're seeing in inflation, because a long time it was a pretty simple story of disinflation. Is it a bit more complicated now?
I don't think it's actually all that complicated. I mean, we have seen that the big moving parts, so the energy shock, the food prices, core goods, they all went up, they've all come down. What we're left with is just a little bit of inflation from some of those sources, and now it's just services inflation, which is the last shoe to drop. So, I mean, really, that's what we ought to be focusing on. That's what the ECB will be focusing on. And in fact, I think the ECB's probably already seen enough on the inflation side of things to feel comfortable in cutting. What they're actually now pivoting towards, moving the goalpost as ever, is wages. And so they're more focused on that now over the next few months.
Right. So if we get, and we're expecting Eurozone inflation to come in at, 2.5% later on today, down from 2. You might have a different forecast. I was looking at the average of the consensus, on the Bloomberg terminal. I mean, we heard from Luis de Guindos saying that what he was looking for, they have to be patient until they saw a clear sign that we were approaching 2%, and then monetary policy would be adjusted. I mean, that seems like a fairly flexible definition of when you move, doesn't it? I mean, 2.5 sounds like we are sort of approaching 2.
I think that's exactly it. Basically, the ECB could cut whenever they want. There's nothing in the data, really, which is preventing them from doing so. The main thing stopping them from doing it is their own intransigence. So what we need to think about as well, and you mentioned it right at the top there, was what's going to happen in the US. Will the ECB feel comfortable cutting if the Fed isn't? And I think probably the answer to that question is no. And so we should be looking at the PCE data. That is probably going to come in hot. And so it's going to be a bumpy ride.
They always tell us it doesn't matter, don't they? That comparison with other central banks.
Yeah. What an economist take. Jamie, there's a concern, a tail risk concern, a very small concern. There's going to be some sort of reacceleration of inflation in the back half of 2024, potentially early 2025. Now, if you look at the Spanish numbers, they're not super hot by any measure, but they are marginally higher. I know we don't really look at Spanish inflation as kind of this canary in the coal mine, but could it be?
I mean, actually, often Spain is one of the good leading indicators of Eurozone inflation. It does seem to move a little bit faster. But on this occasion, I think if you look at like the big strokes, I think what would you actually have to see for inflation to reaccelerate? Well, you need to see companies feeling so comfortable with the demand outlook that they're starting to widen their margins again. That's quite unlikely in a very low, well, as headline inflation's come down, they haven't got that cover anymore, so that's very unlikely. And the second is you have to believe that people who are bargaining over their wages are going to be successful in getting like a high payout. I think that's not very likely either. So those two things not being too likely, I mean, the reinflation story, I think, is pretty much dead in the water, but, you know, we'll see.
Is there, I mean, you say that now.
Yeah.
You just jinxed it,
I've
Jamie.
said a lot of things.
But is there a concern about the reaction function from central banks on both sides of the Atlantic? If we're talking then about, just in the corporate earnings this morning, we've heard services data, wage data, these contracts that you're talking about actually hit the bottom lines of a lot of these companies. It takes a couple of months for that to show up in the data, and then a couple of months for the central banks to react on it.
Yeah.
Could they be late to the game if we do see that reacceleration?
Well, I mean, the main thing they can do now is, if they are really worried about the reacceleration, is just not cut. I mean, I think we all probably agree that policy is restrictive enough. Although maybe there's some questions around that, but I don't think we're likely to see a reacceleration or reignition of the hiking cycle. That seems quite unlikely. It's more going to be that if things disappoint, they're just going to stay tight for longer.
So just pushing the cuts further and further out, it seems. All right, Bloomberg's chief European economist, Jamie Rush, giving us his take on some of the inflation data that we're going to get, both here in Europe and over in the States as well. In the meantime, we go from the macro to arguably the micro, kind of maybe not. We're getting some lines here from the London Stock Exchange CEO, David Schwimmer, on his media call, saying that Europe is still the leading listing venue. We, of course, spoke to him earlier in the show on that IPO pipeline. Take a listen to what he had to say.
The IPO market for exchanges around the world has been pretty grim for the last couple of years, including in the U.S. We are now seeing a much more encouraging IPO pipeline in London. It is more encouraging, more activity, more companies thinking about IPOs than we've seen in a few years. And so I am looking forward to seeing those companies come to list in London. London continues to be, by far, the most successful and leading exchange in Europe, and we compete on a global basis.
Yeah. Well, keep competing on a global basis is a good place to go next then, because we've heard that Shein over in China might decide it wants to list in London. It clearly is a complicated story. Maybe you can tell me your thoughts on that one specifically, or if you can't talk about that one specifically, about China and that being the source of IPOs for the London market.
So I'm not going to be able to comment on any particular specific listing, but I think one thing to recognize about London is that we are the most international capital center, and the London Stock Exchange is the most international exchange in the world. So companies that are looking to access markets globally will find a welcome home in London, and we've seen that over hundreds of years in terms of our history, and I expect that to continue.
That was our conversation with the LSE Group CEO earlier on, David Schwimmer, going on, as Critty was saying, on the media call now to talk about how London's IPO pipeline is seeing more activity and the weaker equity volumes is cyclical. Let's talk about some of this with Sam Unstead, who joins us now from the Markets Today blog. And Sam, I know the blog team has been all over these UK earnings stories. Let's start with the financial services sector, shall we then? We got these numbers from the LSE. There's a story out there, though, that is all about London not being very attractive, and that's what Schwimmer seems to be trying to push back against.
Yeah, so actually you guys had a really good conversation yesterday with Ewan Munro from Newton, and this is kind of something we've written about as well on the blog, is that London kind of has this branding problem. You know, so David Schwimmer was just talking about that it is an international market, you get international exposure, but that's not really how people look at it. People do look at it that you invest in the UK, you're investing in the UK economy, and I think that needs to change before you're really going to see this really significant increase in the pipeline. I'm sure the pipeline does look better, that probably is true, but in all honesty, it could look too much worse than it was last year. Yeah. So it is coming from a very low base.
Well, what's interesting is that there seems to be this narrative that if not London, then where? Because Paris, Frankfurt, Amsterdam also hasn't reestablished itself as kind of a European center or one place of European competition. The Euronext, for example, has tried to kind of consolidate that in some way, but perhaps not as successfully in terms of attracting more of that international outreach that you were just alluding to. just from a language barrier alone, does London have that advantage still going for it?
I think it does, and it does still have, as we're just mentioning, a really international look. So we talk about this all the time. The FTSE 100, most of the FTSE 100 earnings come from elsewhere and all over the globe, right? So what needs to be kind of communicated is that is the case. If you invest in London, you're investing kind of internationally. I think for those other European exchanges, yeah, potentially there's a language barrier issue, but actually the question of like, if we're not going to list in London elsewhere, where else are we going to list? Well, the answer for the most part has been New York.
Yeah, and that was something that many people, I remember people warning about that some 10 years ago when these conversations started to happen. Sam, let me ask you about some of the other corporate earnings here in London, and particularly the consumer-facing things. I mean, we had a conversation with Haleon. That seems to have gone down pretty well with investors, that set of earnings today. Quite a new company to the investor community, but coming on the heels of a very negative statement from a rival yesterday.
Yeah, I think that's why you're seeing such a big move for Haleon shares today. Reckitt Benckiser yesterday, their cold and flu medicines didn't do so well. That's a big part of Haleon's business. Their shares were actually down in the last 3 sessions, and they fell quite a bit yesterday after Reckitt. Their cold and flu sales were actually extremely good over the course of the last year. They're a bit more broad than Reckitt are, so that actually ended up doing quite well. And they announced a buyback, which has kind of been the key theme of the earnings season this year.
Yeah, we've talked about that quite a bit. Sam, thanks so much. Sam Ulster from our Markets Today blog. Thank you for joining us. You can get more from the blog team, of course. Go to the Bloomberg UK website. They've been all over those earnings stories this morning. Or you can type TLIV Go onto the Bloomberg terminal, and you'll find all things UK eco, UK focused, UK corporate there. Plus, on the UK theme, it is one of the most important UK budgets in recent memory. A lot seems to be at stake. And to preview the big event next week, Bloomberg News is putting out a budget game today on our website. You take the role of Chancellor in this game, Chrissy, having to make tough decisions about the economy. You can head to our website to have a go. You can Google Bloomberg budget game. That should take you there. I mean, I had a go, Chrissy.
Yes. How was your experience?
My experience, it was extremely easy not to crash the economy. That was my experience. But I wasn't popular with anybody. So I think therein lies the challenge.
The challenge for politicians. New respect for them, perhaps, when it comes after playing this game. I have not played it yet. I'm a little scared to play it.
Yeah.
Because I feel like, you know, as a journalist and an outsider, it's like, oh, well, this should be easy. And then you actually do it, and it's like, oh, well, actually, maybe not.
It's okay. You can rest assured it's not real.
I take things very seriously.
Yeah. It's a treasury test environment, I suppose, you know.
It's fair. I don't know. Gaming has always been challenging for me. Monopoly, for example, my family is taking very, very seriously. And I hear it's even banned by the royal family here for that reason. So we'll see if I take this quite seriously as well. Of course, but something I plan to play maybe right after the show. Maybe that's what I'll do as a little bit of a breather. In the meantime, we've got some other things to watch on our docket as well. About 9:30 a.m. London time, we've got UK mortgage approval data that is going to hit the Bloomberg terminal at 1 p.m. UK time. German CPI will be released. We had Ollie talking to the Bosch CEO as well about whether Germany is still a sick man of Europe, whether those inflation numbers are actually going to come in hotter than expected. All that about 1 p.m. UK time. 1:30 p.m. London time, the focus shifts to the United States. U.S. PCE and jobless claims will be released, giving that better underlying picture of inflation. Remember, it's the core PCE index. It's not the deflator just yet. That comes tomorrow. And it's the deflator that's the Fed's preferred gauge of inflation. And of course, later in the day, the global February index review, the MSCI is getting rebalanced. We're already seeing a little bit of an increase in volume at the start of trade. Might get to see it at the end of trade as well. That liquidity window for today, plus some Fed speak from Fed Presidents Bostic, Mester, and Goolsbee, all delivering some keynote speeches. So it really is that kind of micro to macro transition for the next 48 hours.
Yeah, really interesting. And I think IAG did that nicely for us. Guy Johnson talking to the CEO of IAG earlier and saying, look, you're at the forefront of this inflation story. We've seen services inflation, and part of that is airfares. And that's been such a strong driver in lots of different geographies. Yeah. He was talking quite robustly about the company's performance. I wonder what that means for the overall macro picture then around services inflation.
He was talking about the performance. He was also talking about the supply chain story, the machinery story. We looked at the hot CPI data, the hot PPI data. PPI data shows up in PCE much faster than the CPI numbers do.
Okay, that is it for Markets Today. Markets today are doing okay, up by 0.3% on Stock 600, FTSE 100 up around that margin as well. US futures a little lower this hour. This is Bloomberg.
are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Though, because that CPI rising 2.7% year on year, Bavaria rising 2.6%. Bavaria, one of, I guess, the metrics that we're looking at the most, and this comes in the context, of course, of, for example, French inflation showing better than expected figures because it's at the lowest since 2021. Now, it does not mean that inflation stays there, but certainly it means that things could be looking up. So it's very likely, and I think we've seen that pretty clear from central banks, it's very likely that the next rate move is down from major central banks. So we're now joined by Beata Manthi, global equity strategist at Citigroup Global Markets, to help me pronounce some of the German names, Beata, which are impossible to pronounce. I know that's important inflation, but also really trying to understand this Fed dynamic. If you look at, the Fed, I mean, just inflation in general, it doesn't feel like it's going to be a linear trajectory.
Absolutely. So, of course, we are seeing the latest data coming a bit surprisingly high. That's a risk. That's been always a risk. That's one of the reasons why we've been adamant the ECB wouldn't hike before June. But of course, this is one data point in the several months of data points coming our way, right? So it's too early to start panicking yet.
So, Beata, when you look at markets in general, I know you have a new note out, which I want to spend a bit of time on, but what do you think is being most misunderstood in the markets? I know there are different market dynamics. Is it a good opportunity to buy some equities?
So we've been getting pushback on our bullish view on equities for several months. You could have asked this question at each single point over the past few months, right? And the market still found the reason to continue higher. But where we think there is an opportunity right now, year to date, we started to see it is, of course, the catch-up trade of other markets versus the US, right? So we are overweight continental Europe over the US, which is neutral, for several reasons. One of them being we are at a cyclical trough in Europe. We've already had hidden EPS recessions in Europe, so we are in an early cycle. And the fact that the economy is starting to pick up from low levels, rates will get cut, that's quite favorable for cyclical markets and sectors to do well.
And I love your recent research, really, viewpoint, basically looking at Europe's Super 7. And so we always talk about the Magnificent 7 in the US, but you've basically identified a group of companies here that could perform very well.
So what is the interesting dynamic this year is that Europe indeed has started to narrow. Yeah. So European index is going up, it's outperforming the US actually, but it's coming up with the narrowing, with the number of stocks contributing to the overall returns coming down and down. We find that this is quite unusual for Europe. It's more usual for the US to happen. But we argue that for these Super 7 stocks that we've identified, if the market decides to narrow further, they look very interesting. So we looked for similar characteristics for what Magnificent 7 have and what drove their outperformance last year. We also noticed that this set of stocks, the Super 7 in Europe, have underperformed since the start of last year by still 70% versus Magnificent 7. They've outperformed almost 10% year to date, but there is a long way to catch up.
So these European Super 7, so you have Novo Nordisk, of course this is all Ozempic, the big story of last year. ASML, that's chips, LVMH, Richemont, Ferrari, so there's a bit of a luxury theme, and then you have SAP and Schneider. What links them all together?
So what we find is when the markets narrow, they narrow for a reason, and usually they narrow to growth. So you want to have growth characteristics. You want to have a superior margin, so quality stocks. But what is different about this set of stocks, so some would argue or some other names should be in this list, but we've on purpose identified those that have economic moats. So we want them to have competitive advantage within their industry groups.
So can Europe actually outperform other equities in the world because of this narrowing?
So the ideal situation for European market to outperform is the market broadening, what we've seen in the fourth quarter of last year, right? Definitely. And what we find that actually at the beginning of new cycle, in the early cycle, markets tend to broaden. So what is happening right now is quite unusual for Europe. But because these stocks have such attractive characteristics and they have lagged the Mag 7 last year, and really international investors are starting to wake up to the idea that Europe has very good companies, very robust business models. They underperformed. This set of stocks is still cheaper than the Magnificent 7. So I think if the market decides to narrow further in the short term, they are a big competition in terms of outperformance for the MAX 7 going forward.
So, Beata, if you say this is very unusual, but it's happening here in Europe, how do you explain it? Because it's a bit of a mess to try and understand where markets in general are going?
So we've done lots of number crunching, and we've looked at historical data till 1990 on a quarterly basis. What is the contribution of top 5 stocks, just for comparative basis, for Europe and for the US? So for Europe, on average, since 1990, top 5 stocks contribute to 25% returns. In Europe, year to date, we have almost 50. In the US, this 25 for Europe becomes 45. So 45 for the US year to date, it's not unusual. It is unusual for Europe, but we really argue that this is subdued market expectations, subdued market pricing view on what EPS could do going forward, and that is triggering this catch-up trade for these attractive European names versus the US.
Beata, and this is not CFA level 5. This is like a meme that I was sent, and it was kind of like looking at the US economy saying it's just being propped up by NVIDIA and Taylor Swift. And there's unfortunately some truth in that. So when you look at NVIDIA, I mean, it's so unusual to have one single stock kind of almost dictating all of the market. What does that tell you about what the market is looking for?
It's definitely, so this is the reason for the narrowing, right? So markets narrow either because we are really worried about growth. Growth is scarce, or we find a new compelling theme that investors really can't not be part of, right?
So this is the name of the game. Beata, as always, thank you so much. Such a great piece of research, so interesting. Beata Manthi, they're a global equity strategist at Citigroup Global Markets. Now, coming up, our exclusive interview with the Irish Enterprise, Trade and Employment Minister, Simon Coveney, will be live from the WTO conference in Abu Dhabi next. And this is Bloomberg.
On the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew, alongside Kaylee Lines, deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. On March 6th, Chancellor of the Exchequer Jeremy Hunt delivers the UK's next budget, with his Conservative Party lagging in the polls ahead of the next general election. Bloomberg Television brings you up-to-the-minute special coverage, Wednesday on Bloomberg.
Now, the World Trade Organization is holding its 13th ministerial conference in Abu Dhabi this week. The most important item on the agenda is reforming the WTO's dispute settlement system, but few are expecting a breakthrough. Well, Bloomberg's Vonnie Quinn is there for us with a guest. Hi, Vonnie.
Hi, Francine. Thank you so much. Let's get straight to Minister Coveney. Minister, we're supposed to be in the final day of negotiations here at the WTO. Are we in the final day? Will we get a chair's text tonight?
Honestly, probably not. There's a lot of pessimism around here, but sometimes that happens before agreement, you know, when you have difficult discussions, which undoubtedly are taking place now. But I think in all likelihood this will probably extend into tomorrow. And on some of the contentious and difficult files, let's wait and see if it's possible to get compromises. But as I say, this has been a difficult week of negotiation. You know, we're in a fantastic space here physically in terms of infrastructure for a conference like this here in Abu Dhabi, but the texts that we're trying to agree in terms of the role of WTO in international trade is a very difficult thing to get progress on this week, if I'm honest.
So there's policies and there's procedure. We'll get to the procedures in a moment, such as the dispute resolution mechanism. On policies, is there going to be an e-commerce tariff moratorium extension? Will India agree to it? They haven't so far.
Well, I certainly hope so. You know, the vast majority of countries, I mean, all but about 4 or 5 countries want to see an extension of what's called the e-commerce moratorium. And just for your listeners, what that means is that everybody agrees not to impose tariffs or taxes on e-commerce across borders. So in other words, we can sell digital products and services without there being barriers to trade.
It extended at the last minute by India, but it extracts concessions for that.
Yeah, so India, but not only India, are saying that they're not happy that the e-commerce moratorium would be extended further. They would like other issues agreed around that. Most other countries are saying, look, we need to agree a work plan in relation to e-commerce for the future to make sure that we deal with things like a digital divide between developed and less developed countries. And we're very much up for that agreement in terms of agreeing a work plan going forward. But in the meantime, we've got to extend a moratorium on any barriers to e-commerce trade. And for a country like Ireland or a country like the US, where there's so much commerce now that is digital in form, it's really important that we don't put barriers to international trade on e-commerce.
Have you done the math? What would it mean for GDP in Ireland?
Well, look, I mean, I think in reality, if you have a small number of countries this week trying to block an extension of the e-commerce moratorium, I think the other countries on a plurilateral basis will probably go ahead and do it anyway. So what you'll have is you'll have no more than half a dozen countries deciding, well, they're not going to apply an e-commerce moratorium, but you'll have the rest of the world doing it. So we would much rather have that as a common agreement across all WTO member states rather than having, you know, 2 or 3 or 4 countries moving in a different direction, because that undermines the credibility of the WTO system. But look, my sense on this is that we may well find a way of getting agreement on extending the e-commerce moratorium, subject to an agreed work program on how to deal with e-commerce between now and the next ministerial meeting in 2 years' time. The other concern, of course, is that some countries are using the e-commerce moratorium as a way of creating leverage to get agreement and compromise on other files.
Such as public stockholding, for example, grain, you know, rice. India maintains that it needs to have those subsidies in order to feed its poor. What's wrong with that position?
So I think everybody here accepts that there are food security issues in many parts of the world. Countries need to be able to hold a certain amount of stock to make sure that if there is a shock to the system, like we saw, for example, linked to the war in Ukraine when, you know, and Russian aggression, that had a severe impact on the price of grain, and it had a knock-on consequence in terms of food security. So countries want to be able to hold a certain amount of stock, particularly in the developing world, to make sure that they can feed their own population in time of crisis. But we need to make sure that what that doesn't lead to is the effective dumping of large amounts of that stock on international markets in a way that would undermine the price of those commodities in the future, because that undermines global trade. So this is about getting the balance right between legitimate food security concerns and at the same time trying to protect a level playing field that determines prices on the basis of demand and supply, rather than dumping large volumes of stock onto international markets that could be very disruptive.
On a slightly different note, many delegations have been using this time here in this region to visit visit places like Saudi Arabia and the GCC countries, as have you.
Yep.
Is there a deal in the near future? Could a deal help solve some of Ireland's infrastructure problems, for example, housing and so on?
Yes, so I've been traveling around the region. You know, I've been in Saudi Arabia, I've been in Kuwait, we've been to Dubai, and obviously spent a lot of time here in Abu Dhabi as well. And look, what's happening in this part of the world in terms of ambition, investment, growth is really quite extraordinary. And that's why we have 16,000 Irish people now working and living across this region, engineers, accountants, architects, construction firms, teachers. But we'd like that relationship to be a two-way relationship. And what's happening in Ireland is also very exciting right now in terms of economic development and infrastructure development. And the two big drivers of that are decarbonisation and digitalisation. So we are planning, for example...
Is there an announcement in the near future?
Well, no, but I do think we will see investment funds in this part of the world investing more in Ireland and in Europe through Ireland in the future, because they see Ireland as a safe space to invest with very pro-enterprise policies. And that's a message that I hope is well heard this week.
Minister Coveney, thank you so much for your time. Francine, I'll hand it back to you from the WTO.
Thank you so much. Arvani Quinn there with Ireland's Minister for Enterprise, Trade and Employment. Now, we'll also be speaking to the U.S. Trade Chief, Catherine Tai, a little bit later today from that same conference, WTO conference in Abu Dhabi. Now, you're also looking at live pictures of the Russian President, Vladimir Putin, who's giving his annual State of the Nation address. It comes just 2 weeks before the Russian presidential election. Now, it's also ahead of Alexei Navalny's funeral on Friday in Moscow. The Russian opposition leader died in a Siberian prison earlier this month, with his family and world leaders blaming the Kremlin. Coming up next week brings one of the most important UK budgets in recent history. So to prepare, Bloomberg is putting you in charge of the nation's finances with the Play the Budget game on the website. It's really really good. I've played it about 5 times to make sure I didn't get a terrible economy at the end of it. We'll be giving it a go live with its creator next. This is Bloomberg.
From the UK, and I'm the inventor of the Gel Razor. And today I'm looking for an angel investor to fund my project, the Gel Razor, whether that's a working concept and working prototype, or manufacturing possibilities with investment, or to get me a licensing deal secured. If you go in any supermarket today, you will see packets of razors sold separately with tins of mousse or gel. Hence I did that all in one. The idea is you pressurise the handle. The gel flows through the reservoir up to the head of the razor, coating the blades, ready for shave. My target market is 18 plus, male or female, male blue version, female pink version. What I'm looking for in an investor is someone who's passionate, determined, shares my vision. That's an important step for me, and willing to succeed as I want it to succeed myself. Patented in the UK in 2021 September. With copyright protection, I have a logo for the Gel Razor, which you will see on my LinkedIn profile. Currently working with a company in the US who have done me a lovely sell sheet. Big up to them guys. So if you're interested, contact me on LinkedIn profile, Paul J. Gwilt, GWILT, or email me at mufc219@gmail.com.
Now, good morning, everyone, and welcome to Bloomberg UK, a special focus on the biggest challenges facing the British government, the economy, financial services, and markets. I'm Francine Lacqua here in London. Now, next Wednesday, an important day for the UK political calendar with one of the most important budget statements in recent years. Now, to preview...
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need. Like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
That will help the Conservative Party win the next election, deliver some tax cuts, get voters on side. But you start from this pretty difficult position, which is where the Office for Budgetary Responsibility says you've only got £13 billion to play with. So your first choice in the game is, am I going to increase the amount of money available for giveaways, or do I stick to the current spending plan? So if you're Chancellor Jeremy Hunt, you probably want to stick to current plans, because if you cut public spending, you could be accused of austerity. So imagine we've done that. And then your next choice is around income tax. So we think the Chancellor is likely to cut at least 1 percentage point off income tax. So let's go for that. Let's cut the basic rate of income tax. We have national insurance. We know that the Chancellor cut that out of the autumn statement. He'd like to do that again, so let's go for that. Let's cut another 1p off national insurance. More tax choices. Stamp duty. This would help homeowners if you were to increase the threshold at which it's paid. Let's imagine we're going for all the tax cuts. Let's increase the stamp duty threshold. Inheritance tax, another big giveaway the Chancellor could do, would cost £7 billion to do it. It's a tax that's not liked in the country. Let's cut that as well. We're going full optimism here. And then finally, you have the fuel duty decision, another big one the Chancellor has to do. He can let that fuel duty freeze. He can maintain it, which would help motorists. And let's say he does that. So we've locked in our decisions. How did we do? We're on our final screen here. Budget day has arrived. And we have crashed the markets. We have gone too far with our tax cuts. As you see, we've gone well into the red with our borrowing. We've blown out our fiscal headroom. We've broken our fiscal rules. We've repeated the Liz Truss episode. I guess this playthrough shows that the Chancellor has that constraint around his headroom. You can't go too far, otherwise you risk the wrath of interest rates rising again and general chaos. So yeah, try to avoid that outcome when playing the game.
I love it so much, Joe. It's fun. I mean, you can do it over and over until you get it right, which I have not been able to do yet. Bloomberg's UK government reporter, Joe Mays, and of course, the creator of the Play the Budget game, which is available for free on the Bloomberg website. It's pretty fun. I also got my kids to do it. They were even worse than me, apart from the youngest one, who's 5. He did great. For viewers in the UK, join us on Wednesday for special coverage of the Chancellor's spring budget, plus all of the reaction and analysis. Our coverage begins at 12:15 with the Chancellor's speech at around 12:30. Coming up, we'll have plenty more on the UK. We'll talk inflation, and then we'll talk also a little bit of luxury. This is Bloomberg.
Is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful, because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime, but we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or you're advising New York
the
City?
mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern every weekday morning at 6 a.m. Eastern, only on Bloomberg.
Now, PwC report says a gender pay gap has widened in the UK, consistently lagging its OECD country partners. Meanwhile, the FTSE Women's Leaders Review was released on Tuesday, showing board representation in the top FTSE 350 companies has reached beyond 40%. I'm pleased to be joined by the Chief Executive of the FTSE Women Leaders Review, Denise Wilson. The review is an independent business-led initiative backed by the government, focusing on increasing women's representation in the FTSE and beyond. So, Denise, thank you so much for joining us. Are you disappointed with what we found out?
No, I mean, I think we've been overridingly pleased with the response to the review and the way British business has got behind this. You know, we know there's still a long way to go on gender pay gap, and much of that, around 75%, is the motherhood penalty. So, you know, we need to do more to address gender balance, bringing men into the home as well as men and women into the workplace. And that's one of the key areas that we've got to work with. But overridingly, you know, FTSE 350 boards are now at 42%, increasing every year. Last year, we hit the target of 40%, 2 years still to go, and showing there's much more gains to come. So that was really encouraging. Then when we look at women in leadership, go ahead.
Yeah, so I was going to ask you about women in leadership. So just over half of the FTSE 350 companies have achieved or are well on the way to achieving gender balance. Is this really positions of power? What I hear from a lot of the females on the boards is that they're on the boards, they talk, but actually they're not the end decision maker, and that makes a big difference.
Well, I think this is a long, this is a long journey. We have been working really hard to bring gender balance to the top of companies, not just boards, but in the leadership team, which is the top 80 to 100 roles, which we capture and monitor. So exec committee and the direct reports underneath. And building there, we have 35% women in that cohort this year, which, you know, a decade ago, it wasn't even measured actually, but if I took a guess, it would have been in single digits. So all of that is progress, but one of our other recommendations is the 4 key roles. So that's the chair, the senior independent director, the finance director, and the CEO. And we've seen strong progress in the SID, in the senior independent director, now 47%, so near parity. Women in the SID role, chairs and FDs in the FTSE 100 increasing this year, 7 or 8 appointments, new women appointments. But, you know, we're always dealing with the law of small numbers. So we need all of the women to stay in post, more women to have been appointed in the year. And so in a typical year, we see just marginal progress. The CEO, as you've heard me say many times before, is our standout disappointing statistic amongst a sea of progress, really, at every other level. And I think what it shows is that there's much more work to be done here. We've still got a way to go. And, you know, these jobs that are in the FTSE 350, there are 260 of them, the most powerful, the most influential, highest paid roles. And CEOs don't give up that job easily. So that was always going to be our very last hill to climb.
So, Denise, how do public companies compare with private companies in the UK?
Look, we've seen really great progress in the private companies. We only started to monitor those 2 years ago. And I think what this has shown is that gender balance, women in senior roles, there's a near normalization of that. And the ripple effect has worked very well. So we were delighted when we saw last year that the private companies were doing well. They've increased again this year to 36%. Boards are slightly different. Boards in the private companies are lagging where the FTSE 350 are at just about 31% and static in the year. And I think that's a function probably, although we've got more research to do here. I think it's a function of there being different board structures in the private companies, more static, more founder-owned. So there's still more work to do there. But there's work to do everywhere until we really start to see women at every table and in every role, and particularly for women of colour, for women with caring responsibilities. We've got a way to go yet, but it's looking good. And
Denise,
what we're doing in the UK is working.
Yeah, the other question I had was, you talk about the motherhood discount. Working from home for companies that actually have mandated that most of the employees have to go back to the office, and if it's largely, I think, women that ask working from home, is there going to be an increase in the gap of senior females in 3, 4, 5 years if they're not visible in the office?
Well, I think it's a great point, and we've got to have a very good lens on that. It's probably early days, but much of this is encouraging men to take a big role in the home, to take a bigger role in the home, encouraging companies to not share just shared parental leave, which has been really quite flat and the take-up is poor, but companies to introduce equal parental leave, to give the same paid leave to men as women. Men bonding early on with their children is pivotal to how they develop with their their roles in the home and help other women in the workplace. So it's quite a complicated piece. And I do think companies have got to have a very close lens on that. They've got to make sure that they're not. It may sound great to say we let our employees do what we want, they let them choose, but then if you end up with, as you say, women predominantly in the home looking after the domestic responsibilities while men are in the workplace, and that two-tier structure is going to be unhelpful to progress. So making sure that the rules apply to everybody and everybody does the same.
Yeah.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
Generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
A report this week by the UK's competition watchdog into the chronic housing shortage was more controversial than expected. The CMA has opened a cartel investigation into information sharing between 8 home builders, including Barratt, Taylor Wimpey and Persimmon. It comes with the sector already under heavy pressure for failing to deliver enough affordable housing to meet demand. Now let's discuss all of this with Bloomberg's real estate reporter Jack Sitters and John Stepek, author of Bloomberg's Money Distilled newsletter. This is the segment that everyone in the newsroom is watching because we have a number of people trying to get on the property ladder. Jack, give us a sense, first of all, on how, you're looking at rising rents. There's, this cartel. Like, how's property in general doing in the UK?
Well, big picture, I guess if we'd had this conversation a year ago, off the back of the mini budget, we might have been talking about, the housing market looks, really problematic, potential for significant declines. And I think the data basically hasn't really borne that out. In real terms, prices definitely have corrected to some degree, but it's been nothing like as kind of gloomy as we might have expected. The home builders, they've massively pulled back in terms of how much they're building, which, is a big part of what we're talking about here with the CMA. And because this small group of big home builders are responsible for such a big proportion of housing output, they're a really, really important part of the market. Now, obviously, the reason they've pulled back significantly, they're expecting demand to be lower, mortgage costs are higher. But part of what that does is it helps keep pricing there. And that was one of the things that the CMA was looking into.
Yeah, and John, I know a lot of people have seen cartel, CMA. We saw a pullback in some of these home builders in terms of the stock price, but you're not too worried about it.
Well, I mean, worried is maybe not the right word, but I think the house builders, by and large, there have been elements of this that they were quite pleased about, because the cartel investigation is basically a side issue. It's almost like the competition authorities gone into this and said, OK, well, there's this bit where it looks like they might be discussing with each other. We better delve into that deeper. But one of the big issues, for example, has always been, and certainly one of the big political hot buttons, has been the idea that developers are sitting on more land than they should be in order to basically drive up prices artificially. And the CMA basically turned around and said, well, actually, no, if we look at the land banks, A, the amount of land that the house builders own is not that concerning in itself, and B, the fact that they own so much is because the planning system is basically really poor. And it takes so long to get through that you need a big bank of land in order to keep the developing going. And also, I think the other thing that was interesting is the CMA very clearly drew a line between what it described as housing demand and housing need. And the big difference is that obviously housing demand is people wanting to buy houses, but housing need is actually the fact that obviously everyone needs to live in a house, and not everyone can afford to buy one. And the problem is that the house building sector and the private house building sector can only really be expected to respond to housing demand. Yeah. They aren't in and of themselves going to automatically build enough houses to meet need. And I think it was that the focus of this investigation very much ended up being kind of punting the problem back to the government. It's like, look, the house builders, there's issues, but actually, if you want more houses, the government has to do something about the planning system.
Yeah, on the policy side, right? Yeah. That's kind of how the easiest way, I guess, to fix things. Jack, give me a sense of, so I know you're looking at commercial real estate. I mean, you cover everything, basically. And I know there's a lot of questions. We had mortgage approvals that were higher than in the past. I mean, is it easier to get a mortgage? How much do you spend your time on, figuring out mortgages and rents, or commercial real estate going like Ari?
Yeah, well, so I think credit availability, very broadly, should we say, is crucial. So on the residential side, mortgage approvals going back up. I think the kind of key number there is what's happening with swap rates, and they've been coming down a little bit. So that's broadly good for mortgage availability, albeit that that's moved slightly the other way more recently, but it's still a lot cheaper than it was. So that's kind of supportive for the housing market. On the commercial side, it's still feeding through to pricing. And credit availability, again, is all important, and also that kind of premium over the risk-free rate. So a lot of what we've been looking at recently is banks impairing their loan books or recognising potential losses from commercial real estate lending. For now, that's been sort of focused in the US, where the office market is very problematic, but we've had a lot of European banks reporting over the last week or two, and they're starting to increase their provisions too, so it's not just a US issue. For the UK, I think what we can say is probably the big UK lenders, NatWest, Lloyds, have broadly been much more conservative in where they've been lending on the commercial real estate side over this cycle, lending probably at loan-to-value ratios of sort of 50, 55%, which means you'd have to have a really, really big, crash in property prices to impact them too severely. But some of the German banks, which we've been writing about, because pricing got so elevated there, that's starting to look more interesting, and there's an expectation that that we might need to see much more significant provisions there.
And John, so we have, of course, the UK budget. What are you expecting for house prices from now until the end of the year? This is my favorite question to John Steppe, because he always gives me news.
I think the credit availability, I think that Jack just mentioned, is very much the main point. And while credit availability has picked up a bit over the last year, we still have to remember it's a lot more expensive than it was 2 or 3 years ago to buy a house. So on the one hand, as long as the economy stays kind of mediocre and the jobs market stays strong, then I don't see any reason for house prices to massively collapse, because people will be able to pay their mortgages and there's no forced sellers. At the same time, if interest rates remain around current levels, and recently mortgage rates have been kind of flattening out as opposed to dropping back, it's hard to see how you get a massive kind of rally from here, because people are already at the top end of their affordability.
So interesting. Thank you both for joining us, Bloomberg's Jack Sitters and John Steppe. Coming up, we're joined by the chief executive of Moncler, the luxury brand, reporting a year of industry-beating growth. Well, that's coming up next. We speak with Remo Ruffini, and this is Bloomberg.
Studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. To the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Now, with the muted reopening of the Chinese economy and a slowing demand in Europe and the US, luxury stocks haven't had the easiest rise this year. but some have been doing better than expected. And Moncler's results came in ahead of estimates, prompting some analysts to lift price targets for the Italian luxury company. Bloomberg Intelligence also says the company is well positioned to weather a difficult economy. Now, after a year of industry-beating growth, the brand also unveiled the Winter 2024 Grenoble collection, a range closest to the technical mountaineering roots of the company, where I'm delighted to be joined by Remo Ruffini, the chairman and chief executive officer of Moncler. Remo, as always, thank you so much for speaking to Bloomberg. Now, you've had a pretty good couple of quarters. You came out with earnings. Again, they beat analyst estimates. Are you expecting a pickup in the U.S.? Have we seen the worst of U.S. consumer demand?
Basically, U.S. was quite difficult last year. Was not an easy moment, and now is better. But again, last year was a very good year for us, very volatile. We expect 2024, volatile as well. I hope not, but the first 2 months are very good, and but our concern is really to watch carefully the world, watch carefully the customer, because learning from last year that was super volatile, we are ready to be careful of this current year.
Mr. Ruffini, are you expecting or are you seeing any signs of a recovery in China?
China is, again, very good. We have the last quarter of last year as China's quite successful. Chinese New Year was as well very, very strong. And now is slowly to be, but because it's finished the vacation, it's like Christmas in Europe, but still China strong. And for us, it's very, very interesting market. All the Chinese is strong. They are strong in China as well, traveling all around, in Korea, in Japan, and we have in Europe as well. They almost recover, from 2019. A lot of travelers, Chinese travelers, are in Europe, and Hong Kong is back. Hong Kong, the biggest news is Hong Kong is back. As you know, was in crisis since 2017-18, and now is the customer are back. The Chinese, they continue to travel to Hong Kong, and honestly, the Asia is quite solid market for us.
So, Remo, what concerns you the most, and what are you most positive about? I know there's, again, you talk about volatility, there are wars, consumer demand, I guess, is getting more picky. Do you focus on pricing or your supply chain? What's the biggest worry?
For sure, the inflation that we have in the last couple of years was impacting the price. We not increase the price. We only put the increasing cost of the raw material and the manufacture. Having said that, what worries more is really the change on behavior of the customer. They really change the trend. They're really super fast to change. Everybody today talking about this, let's say, white luxury is a very popular word. And only 1 year ago was the market was very, very maximalistic, very, very streetwear. Now it's very quiet, very, very quality, very, 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 very sophisticated. And you have to stay tuned with the customer. You have to stay tuned with the community. You have to stay tuned with everyone around the world, because the trend could change from day to night. It means it's quite tricky.
Remo, you also did a pretty impressive Grenoble show, and there was a lot of people saying, look, you may be going back to some of your roots. We're looking at beautiful pictures of people skiing. Are you going to, what's the right way to do luxury right now? A lot of people are saying there are too many luxury companies out there. How do you differentiate yourself?
Actually, we are quite unique. Uniqueness for me is everything. If we just changed our strategy 1 year ago, is based on one brand, Moncler, and 3 dimensions: Moncler Collection, Genius, and Moncler Grenoble. I think we demonstrated in the last 18 months with the 3 events, one in Milano in Piazza del Duomo, one in London with Genius, and the last show we did in St. Moritz a couple of weeks, 3 weeks ago. I think our dimension is there, our strategy is there. I'm very confident that we have a clear idea for the next 3 years, because we really give to the customer a Moncler approach. We try to be, as I always say,
beyond fashion, but at the same time, we stay tuned with this world, but not losing our roots. If you watch the last show we did, is really in the luxury world, but in the middle of the forest is really a fire tale. I think it's something super interesting. I'm quite confident that our strategy is very solid. We can work very well in the next 3 years.
Remo, it's also been a few years since you acquired Stone Island. I remember talking to you about it on this very program. Given some of the pressures that some of the smaller luxury companies have, are you ready or looking for another acquisition?
So basically, Stone Island is in their good moment because we need couple of years to redesign the organization, redesign the distribution, redesign the strategy. Because as you know, we love to go DTC, direct to customer. Direct to customer approach is really very important for the strategy we normally use at Moncler. After the 2 years, I mean, we're really ready now to start talking with the customer in the right way, to have the right distribution, the right stores. And for the next acquisition is not today, or not tomorrow, because honestly, as I said before, we have a lot of things to do for Moncler. We just start our new strategy, and we just started to redesign Stone Island in terms of marketing, in terms of communication, in terms of everything. And I think we have a couple of years, 2 to 3 years for both brands, very, very intensive. And I trust a lot we are in the right track. Honestly, another brand could be tricky for us.
Remo, when you look at some of, I guess, the opportunities out there, do you sell differently to your customers now in 2024 than you did 5, 6 years ago? Is the world of luxury really changing? And what does that mean for Moncler for you to stay on top?
It's changed a lot, Think only about omnichannel. Omnichannel is everything. If you want to stay tuned with all the customer, you need different touch point, and to not to sell, but just to to improve your brand perception. 5 years ago was totally different. Now we have honestly to improve a lot this journey, because I think especially now that wholesale is not successful as a couple of years ago. Digital is okay. I think we have really to build up a strong touch point with the same concept, the same image, the same approach, the same experience, and give the possibility to our community to go around all our touch point and find the same Moncler with the same spirit, with the same charming, let's say.
Remo, thank you so much for joining us today. Remo Ruffini, there, the Chairman and Chief Executive Officer of Moncler. Now, we'll have plenty more, of course, on luxury throughout the day. Also, a piece of news on Siemens Energy and its wind turbine unit, Gamesa, which posted losses of more than 4 billion euros for 2023 due to faulty turbines and unprofitable contacts. Now, Siemens Energy has obtained a $4 billion sustainability-linked revolving credit facility to replace its existing credit line, and that subsidiary of Siemens, you can see, up 2.6% is what the share price is doing.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists. Because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
From the world of of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Good morning from our world headquarters in New York. I'm Manus Cranny.
And I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
The stage is set for this week's main eco event. We're counting down to the U.S. PCE data, 8:30 a.m. Eastern.
U.S. lawmakers strike a deal to avert an imminent government shutdown. Meanwhile, it's the end of an era. Mitch McConnell announces he will step down after November's election.
And Bitcoin's back. The cryptocurrency soars above $60,000 as surging ETF demand puts a new record in sight. I knew I should have done a little bit of Bitcoin at some stage in my life.
Yeah, and we might be too late on that train, I think.
Touch of FOMO. The question is, for the bond market, are you ready for a little bit of a surprise? How hot will the PCE be? Will the Fed look through the presumption that you're going to get plus 0.4%? Either way, as yields pop a little bit higher, it is all about the super core, in case you didn't know. Plus 0.57% versus plus 0.28%. There's a raft of Fed speak that came out yesterday, a methodical movement by the Fed, according to Collins. Williams, we're not going to be governed by a calendar. And Bostic, of course, we're playing the long game. So the market is just incrementally worried. Now, when it comes to rhetoric from central banks, we have a message from Mr. Takata at the BOJ. Price target is finally coming into sight. So this is all about what is the next move from the Bank of Japan. The entrenched belief that wages and inflations won't rise. So it's going to get harder for dollar to test the upside. The question is it going to be just one move and done? That's the intonation from Takata. And Bitcoin, all hail the cryptocurrency, up 13% on Wednesday. This is the personification of euphoria, up 3.48%. Liquidity is quite literally gushing into those ETFs. Good morning.
It's leap day and it's already getting weird. It's weird that Bitcoin,
I knew
isn't it?
Did.
No, I mean, it is the weird Z day and we're having a weird Z's type of market. Not to mention, okay, it's not just leap day, it's also the end of the month. And we get that month-end rebalancing from pensions. According to Goldman Sachs, we're going to see $16 billion worth of sales of U.S. stocks, and that's likely going to rebalance into bonds. So maybe that's why we're selling off today. Okay, it could be PCE jitters, but again, don't forget, it's also an options expiry. So you get S&P and NASDAQ futures down by about 0.25%. By the way, we learned in a filing yesterday that insiders sold $80 million worth of NVIDIA stock. So they cashed out. Did you ride that wave? Finally, Russell 2000 futures, my small caps, outperforming this morning, up 0.2%. But again, maybe it's just a bunch of rebalancing because they've done so poorly. Maybe now's the time to go in. But Manus, you are so right with Bitcoin. It is the FOMO YOLO market And seems like it's back. It's not just Bitcoin. Some areas of the stock market have insane call options built around them. And Goldman Sachs' Scott Rubner put this really well. He talked about this idea of uncertainty and calling it top. U.S. equities have entered a period of euphoria, which has proved impossible to call the top. March suggests a fuller house, and the rally is tired. However, there is no catalyst for a potential sell-off, and this has left market participants unhedged. Manis, that is the risk. Things look so good here at the top that you're not buying hedges. So what happens when it falls?
Well, then you're going to hear the other side of that trade, which is, to spend money buying volatility, to spend money buying put options is dead money. And you're going to hear from every single hedge fund, or not hedge fund manager, but every single asset manager which is deployed to a more defensive balance sheet, deployed to those balance sheets that are stronger and more robust. But it's the unhedged part which is perhaps a little bit more worrisome.
Well, we get PCE today. What if that's the thing that breaks markets and we are unhedged for it?
She's got the sword of Damocles on these markets. Just before we get to our guests, let's just bring some breaking news headlines to our viewers this morning. It's just gone 5:03, and these are from Ukraine. They see the risk of Russia breaking through their defenses by this summer. So this is an assessment of what's going on the battlefield at the moment. Very prescient. They talk about the situation being bleak. So that's something to bear in mind. Danny?
Yeah, they even go so far as to say that they have to ration their ammunition. And the call here is they need more supply of ammunition from allies in order to avoid this fate.
This will play hard in the Capitol Hill discussion because, of course, still we're waiting for the United States to sign off support for Ukraine and Israel as Europe tries to find solutions, the military solutions, to help Europe. Let's talk about markets with Maria Waitman. She joins us now, senior multi-asset strategist at State Street. Maria, good to have you with us. Straight to the killer line is that it's hard to call a top of this market and that we are unhedged. Do you feel that this market, that participants are blindly living in FOMO and simply leaving themselves unhedged? Good morning.
Good morning. I think it's fair to say that the biggest position institutional investors have, and we see it through State Street custodial database, is to be long U.S. stocks, to be long tech. That's the biggest position they have. Is it dangerous? How dangerous it is? I mean, tech is still the area with the strongest earnings, strongest margins, highest return on equity. I mean, the list of superlatives is very long, strongest balance sheet, plenty of cash. So is that unhedged? So they own the, I don't know, quote unquote, the highest quality, best part of the equity market. But the other thing they own, which is really interesting to me, is cash. So cash positions are elevated. So what investors own is cash and tech. So do you call it unhedged? I probably wouldn't call it unhedged. I think to me it's actually quite good barbell.
Okay, yeah, fair enough. But this is, I think, what maybe is more concerning, at least to Goldman Sachs, is this return of the YOLO trade. It seems like we are yet again living in a COVID environment where people are in their basements buying call options. I have a chart of Palo Alto calls. I should say, Maria, this isn't the only stock that's doing this. Things like Sound AI also seeing this type of environment. I mean, how worried should we be when you see things like this, call options going out of control, Bitcoin going past 60,000? Is that retail trader who's pumping up these various stocks, is that risk existing in this market again?
I think you're right. Retail is playing part, but I think institutions as well. I think asset owners, and what, to our mind, driving this kind of surge for risk, for yield, is very, very low volatility in the market, right? If you look at any measure of volatility, I mean, if anybody told you that at the beginning of like when rates are really elevated and we're debating how many cuts will be and volatility would be that low, I think everybody would be surprised. But the fact that, I mean, perhaps that volatility, like yield curves are quite synchronized and inflation is declining in a very consistent manner, that perhaps drives volatility lower, and that entices investors to take risk.
Well, Maria, look, we can debate. Either way, you can't really afford to be out of this market. As you say, you've got a really interesting barbell, long tech, and long cash. I want to put this proposition to you. It is from Julian Emmanuel at Evercore, and I find it quite interesting. It took me back to some moments in time that I've lived through. FOMO environments tend to end without warning or correct rapidly. For example, Y2K in the 2020s, we had the NASDAQ well. In 2018, we had Volmageddon, where while there are many catalysts to stop the FOMO momentum, the signs are few and far between. So we're in this euphoria period. With that in mind, how do you take more risk in the tails? If the barbell is tech and cash, where am I going to get the upside? I'm seeing 5,500 from UBS on equities. I'm seeing smaller incremental at higher levels on equities. So to get more return, is it going to be in core equities?
And that's the question that everyone is asking. Is it what else can you buy other than tech? Tech is rallying, and people are very, very uncomfortable with it because how elevated it is and how concentrated the market is. But what else would we buy? Would you buy small caps? Would you buy value? Would you buy Europe? Would you buy China? And I think to all of those questions, answer is no. Because what I really worry about is there is a in our minds, there is a fairly high chance of recession. I mean, we still see inflation not really budging down. We still see U.S. economy being strong. So for us, it's higher for longer, no lending, and potential crash later. So I really want to be in a large cap quality stocks. And outside tech, I don't know, maybe healthcare can be there, but it's this U.S. and tech. I honestly really struggle to find what else to buy.
Maria, does that make you feel uncomfortable? I mean, that seems so wild. This idea, it's literally just big tech, maybe some healthcare, but are you uncomfortable holding that kind of position? And again, I understand the thesis behind it, but just mentally, is that a tough hurdle to get over?
Yeah, no, I think you're right. It's really hard to go to a client, and I'm sure for portfolio managers, to go and buy something that is really expensive and very crowded. But that's a momentum trade. That's what we're living through. And if you look at performance of momentum stocks, that's probably the strongest factor right now. So investors are kind of stuck with this really uncomfortable position.
You worry that we are underestimating the risk of a recession. Now, we'll get a little bit more data today. We're going to get the PCE today. We're going to get incrementally more data. Inflation is bifurcated in Europe. Inflation data here in the United States of America maybe getting a little bit toppy. What is it that raises even a yellow flag on the risk of a more material slowdown? Because right now, the data is not giving us those flags, is it?
I mean, for me, the things that I'm watching very carefully is bank lending. And we're seeing, particularly in U.S., a lot of, CNI, the commercial loans are negative. Year-on-year growth is negative. And for consumer side, really the only place where we see increase in lending is a credit card segment. So that's uncomfortable. That's 20+% interest rate. So I think that's the kind of the thing to watch. As we know, without kind of borrowing and kind of like bank lending, it's very, very hard to expand businesses, and profitability usually suffers. What we know that corporates finally need to refinance, or beginning to the place where they need to refinance all those cheap loans they got during COVID liquidity injections. So that's really the place where we're really concerned is lending side and banking side. And I think there are quite a lot of yellow flags there.
Maria, certainly an uncomfortable market. You put it really well. Thank you so much for joining us this morning, living through the uncomfortability with us, Maria Waitman of State Street. Okay, Manis, let's get to some of the other top stories that are trending on the terminal this morning. The Labor Department sowed confusion this week with an email about a key factor in January CPI. The note, which the department later tried to retract, suggested a surge in a measure of rental inflation that left analysts puzzled was caused by the subcomponent weighting adjustments.
China banned a top-performing quant fund from stock index futures markets and vowed tighter oversight on high-speed trading. Now, this move expands a crackdown on computer-driven investment strategies that some have blamed for exacerbating market turmoil.
The U.S. Supreme Court says it will take up Donald Trump's bid for immunity from prosecution on charges to overturn the 2020 elections. The justices said they will hear arguments in late April, which could mean the prospect of a trial could face a lengthy delay, potentially until after the November election.
Coming up, as Trump and Biden rematch, that inches closer, we have a new poll revealing how much voters are actually concerned with the president's age, a second term for the former president.
And it might be a difficult environment for fundraising, but in that, EQT, the private equity giant, has raised $24 billion for one of the largest private equity funds ever. Eric Liu, EQT's head of North American private equity, joins us on the show later this hour here on Bloomberg Brief.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
You're watching Bloomberg Brief with Danny Berger and Manus Cranny in New York. So we've just got a new Bloomberg News Morning Consult poll. It's broken just moments ago, and it found that Trump is maintaining his lead in swing states, and voters seem concerned about President Biden's age. Joining us to break down the numbers is Bloomberg's Anne-Marie Horder. And surprise, surprise, Biden's age is a concern.
And it's a big concern, though. I mean, there's a lot of concerns regarding the current president in terms of a lot of issues he's dealing with, whether it's top of mind still remains for voters, the economy, immigration is starting to also become a bigger issue. The president will be at the border today, as well as the former president at the border today. But when it comes to the age, this is going to be the stickiest and the trickiest for the Biden administration, the campaign, to really try to deal with. And this comes after the special counsel report, which called the president, quote, a well-meaning elderly man with a poor memory. Now, we did see pushback, though, from his physician yesterday. Biden was at Walter Reed Medical Center. He had his physical yearly exam, and the physician said yesterday he's, quote, fit for duty, healthy, active, robust, 81-year-old. But it doesn't matter what a physician says. It really doesn't matter what the special counsel says. It's what Americans in these swing states feel, and they just feel that he is too old. There's one caveat, though, in the data that I like to bring up. We've had a number of these polls tracking, and 3 of the 5 surveys we've conducted since October, Biden still leads Trump with voters who have unfavorable views of both of them. And that could be critical in these swing states and really the individuals who may decide this election.
I mean, if you dig a little bit deeper into it, okay, 80% see Biden as being too old, but 51% see Trump as being too old, but then dig a little bit deeper again in the swing states, and 6 in 10 voters in the swing states see Trump as dangerous. Although it's in the weeds, isn't it? Because those are the undecided voters. So there's sort of something for everybody here. But what's the takeaway? Because we talked about immigration and we've talked about the economy. Is there any evolution on that in terms of what's going to be most important?
What we have seen an uptick, because we've done these polls for months now, is that people are starting to feel better about the economy. They are starting to feel better about the economy. The issue the Biden administration has is they're not giving Biden the credit for feeling better at the economy. One thing also we've noticed is that while still the economy remains the top issue, immigration is starting to tick higher. And we do know that this is something that the Trump campaign, they put a lot of pressure on Republicans to not deal with that border deal that the Senate backed in a bipartisan fashion, the Ukraine aid, also a border agreement, because they wanted to make this an election issue. Right. One thing we did find in our survey, though, is that, yes, Biden gets a lot of the blame when it comes to the election, comes to the border. We are seeing more of an uptick of also individuals who say, it's also Republicans' fault and the former Trump administration's fault.
Well, it's one of the data points Manus mentioned, this idea that almost half of the swing voters called Trump dangerous. A lot of that probably, I'm assuming, has to do with some of his prosecution cases and the immunity from criminal prosecution. We know the Supreme Court is going to take it up. I'm assuming that just means delay, delay, delay. So is that good news for Trump?
It's a big win for the Trump campaign, because even though likely the Supreme Court's going to allow this case to go through when you speak to analysts, the fact of the matter is it may delay it, and there's a small margin now of when they can get this trial done before the November election. Trump wants this trial to go well through next year, doesn't want it to get done before the November election, because if you look in our data from our polling, swing state voters say he'll be unfit for office. They may not vote for him if he's convicted on any of these criminal charges. So that's one issue. And I also would note, when voters say he's dangerous, a lot of this has to do with the fact that he really degraded NATO. And this poll was conducted after those comments. And I think that's what some of these swing state voters are starting to reconcile with as well.
But this entire election will come down to those swing states, and that is why these polls are incredibly important. We've avoided a government shutdown. I mean, the news flow yesterday was significant, wasn't it? It was McConnell.
I can't believe you woke up early, Anne-Marie, to come in here. That's a lot to keep track of.
She goes the extra mile for Bloomberg Brief and surveillance. It's called Bloomberg Productivity. Look, McConnell steps back, but what I was drawn to was the extension in the funding of the government. Mike Johnson's getting pretty punchy with the tail risk in his own party at the moment.
Well, so they haven't actually voted yet, so we could stumble into one, but it's likely.
Don't do that to us.
It's likely we're going to avoid a government shutdown, but what they're doing is just kicking the can further down the road. They're moving the goalposts so that they just have a little bit more time to get these appropriation bills done. The issue Speaker Johnson has is he's not going to get the votes from the hard right flank of his party. And I'm interested to see the vote count, actually, when this funding measure goes on the floor, this stopgap measure. Will it be more heavy? Well, Democrats will vote for it more heavily, but will Johnson even get the majority of his party to vote for this? Because he promised no more continuing resolutions. He obviously has to put one on the floor. So the government remains open for now. I think the key date is April 30th. If appropriation bills are not done by April 30th, there's a 1% cut across the federal government. And this was the deal that former Speaker McCarthy cut with President Biden.
Does this mean Johnson's possibly at risk once you see the votes come through? Is that taking it too far? Is that sort of extrapolating too far?
Well, he's walking a fine line with the hard right flank of his Republican Party. We heard from Ralph Norman last night, a Republican on balance of power, talking about the fact that he's going to vote no on this continuing resolution. Yeah. But there are individuals like Byron Donalds who are giving him a little bit of grace. They're saying, look, he's dealing with a difficult multiple factions of our party, and his quote was, he's learning on the fly. So I think they might give him a little bit of grace, but of course, they hold that power to motion to vacate, and he could see a similar fate as former Speaker McCarthy did.
We like to keep Anne-Marie Horder busy with everything on Capitol Hill. Our thanks to you, Anne-Marie. We'll see you a little bit later on. And of course, you can catch Anne-Marie during the next 3 hours of programming, 6 to 9, with Team Surveillance. Good morning from New York and Bloomberg Brief.
the EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
It's Bloomberg Brief Managed. We got a little bit of research out from Morgan Stanley on how hot
Great research.
the Rolex market is. It is amazing how dominant Rolexes are. They have broken the $10 billion milestone in terms of sale. They have 30% of the luxury watch market share. That is a crazy number. That is a huge portion. 1/3 of luxury watches belong to Rolex.
And there's still a scarcity value. I can assure you, if you want a Daytona, a Submariner, I mean, anybody can get a Datejust, but it's a Datejust. It is about that scarcity value.
Yes.
It still carries through, and I think even if you look at some of the other products in that family, Tudor, you know the one branded by Beckham?
Yeah.
I've said branded by Beckham, but
Well, the advertising
promoted by
everywhere,
Beckham.
yeah.
I mean, 545 million pieces of Tudor have gone out. So just the sheer heft that Rolex has in this market, and the pricing in the secondary market also holds up.
You know, my favorite thing you do on social media is when you go to the Dubai airport and go to Rolex and say, do you have any Rolexes in store? And it's always, we got nothing.
I gotta say, those empty shelves during the pandemic, I was the only traveler, they told a huge story about supply chain.
They did. Well, Rolex, long reign Rolex, selling.
We've been so used to the fact that every time there's a problem, central banks come and ease. This has been the kind of playbook, you know, throughout my career, before that, after I left. Now we're in a very different environment. Central banks actually have to create a recession, in essence, to get back to price stability. So it's a complete reversal of the modus operandi, in a sense, of central banks as they've known it for the last several decades. So that's why it's not so much that they're getting something wrong. They've now acknowledged that there is this trade-off, these costs to pay, but it's a completely different way of thinking about central banks, and it's a different role. Another way to put it is they have to be unpopular now in order to get inflation back down, where it used to be you could count on them each time to rescue you, to stabilize the system, to bring support. And that has shifted. And I think many people, even in the markets, have not quite understood in my mind how much we are now in a different regime compared to the last 4 decades, effectively.
So it's what, almost an easing bias in the markets? How would you describe it?
In the U.S., yes. And I think it's this idea, this almost pre-programmed idea, when there is a problem, i.e. potential recession, central banks will come and ease.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders.
Watch Wednesdays on Bloomberg Television.
Welcome back to Bloomberg Brief. I'm Manus Cranny in New York.
And I'm Danny Berger. Here's what you need to know.
The stage is set for this week's main eco event. We're counting down to the U.S. PCE data due at 8:30 a.m. Eastern.
A new Bloomberg News Morning Consult poll finds swing state voters think President Biden is too old for a second term and Donald Trump is dangerous.
And Bitcoin's back. The cryptocurrency soars above $60,000 as surging ETF demand puts in sight of a record high.
Bitcoin is back, FOMO is back, YOLO is back. I'm sorry, is this end 2020, 2021 again? Are we living through this again, really?
It's a redux of trading meme stocks in your basement.
It really is. That's what Goldman Sachs says, at least. But maybe we take a break from that today because, you know, it's a rebalancing day. Let me show you what these markets are doing. It's end of the month. We're going to get rebalancing, especially from pensions. Goldman Sachs also adds that we're likely to see $16 billion worth of selling of equities by pensions, and that's likely to go into this bond market. So maybe that's what you're seeing, or maybe it's just PCE nerves. Should we be nervous? We're going to talk to Mike McKee about it in just a moment. S&P futures and NASDAQ futures both down about 0.25%. By the way, in the middle of that NVIDIA frenzy, insiders sold $80 million worth of the stock. So they're certainly saying now is the time to take profit. Russell 2000 futures, those are up by about 0.2%. Manus, it's my favorite time of the morning. My check on my small caps, especially when they're doing well.
YOLO, FOMO, who knows what the right scenario is, but this market is unhedged, and that's the sentiment from Goldman Sachs. Should you use treasuries as a hedge? Today we're nervous. Not normally do you see this bond market up by 4 basis points. It's not huge, but we are nervous ahead of PCE. We're going to talk to Mike in just a moment in terms of the core, the super core PCE, and what drives that, and why is it going to come in slightly hotter. The message from the Fed is very, very clear. We won't be drawn to a calendar. We won't be drawn to a timeline. We're going to be methodical, according to Collins. And in terms of Bostic, we're playing the long game. So we're getting set for a bit of an irritation from PCE. How much will the Fed look through? That dollar-yen, again, the message from the Bank of Japan is clear. The price target is finally coming into sight. This could well mean a one-notch move from the Bank of Japan. That's the intonation from the Bank of Japan, Takata, an official there. So that has capped the upper echelons of the dollar, and perhaps it opens up the trap door to a stronger yen. We talked about Bitcoin again. Wild ride in Bitcoin, up 13% on Wednesday. We're up another 3% this morning. This is the very personification of euphoria as liquidity gushes into those ETFs, nearly $7 billion since January the 11th. Danny.
Yeah, it's risk on, it's YOLO back, but Maria Waitman put it really well when she said, look, the only thing you can buy right now is tech, and you can hold cash. That'll protect you. But it was so interesting because you could almost see the internal debate that she was struggling with, that tech looks good, it is quality, and there's nothing else out there to buy. So you kind of have to hold your nose and just get into the trade.
And normally Maria comes up with other ideas, let's say perhaps in the European market, the Chinese market. Not like Jeff Yu. Jeff Yu was a spice in emerging market bonds. She was very reluctant to pick up any other market apart from US, high quality, big cap, tech, and cash.
Yeah, she literally said, what else can you buy? There's nothing else.
There is nothing else. Well, let's talk about today's key event. It is the Fed's preferred measure of inflation, core PCE, and that is expected to hit the January numbers, highlighting the bumpy path to taming price pressures. The New York Fed President, John Williams, spoke about how we have a long way to go to get to the magic 2% inflation target.
Back in December, my colleagues and I put out what we call projections or forecasts, and the median was for 3 rate cuts this year in 2024. We're data dependent. We're going to watch the data. I'm going to watch the data. A sign of success to me is that, with inflation coming down and the economy so strong, that we can, be thinking about doing that, I would say, later this year.
Okay, we have our economic and policy correspondent, Mike McKee, side by side with us this morning. I mean, the message from the Fed, Mike, was very clear. Williams says it's not going to be calendar dependent. How hot will this super core be?
Well, that's the question. The CPI came in much hotter than we anticipated, and that upset a lot of people on Wall Street and helped bring together the market and the Fed in terms of what they're projecting for the year. There are some things that feed from CPI and the hotter than expected PPI into the PCE that has those who really take this apart and study it looking at maybe a 0.4 gain, which would be the hottest in some time. It won't really affect the trajectory of inflation too much because on a year-over-year basis with base effects, that's still expected to go down. But it is kind of a warning to the Fed that they're not there yet. And the Fed, in turn, as you heard from John Williams, is warning you not to get overexcited about it.
It's hard not to. There's not much else going on today.
You got to make something come alive. Come on, Mike.
Tell me this, Mike. How might Wall Street be to blame if it comes in hot?
This is what we call the Pogo problem.
Okay.
You remember the old comic strip Pogo? We have met the enemy and he is us. One of the factors that goes into the PCE that doesn't really show up in CPI is portfolio management fees. And you can see, you were talking a minute ago about 2021-22. You can see how much business has been done in the markets. And that's the percentage change on a month-over-month basis in terms of portfolio management fees. They went up more than 5% last month. And if that happens again, it's going to put upward pressure on the PCE. Wall Street's doing so well that it's actually raising inflation.
Now, sowing the seeds of confusion, of course, we have the Labor Department sowing their own seeds of confusion. Talk to me about the email that was sent out. What was in it? Why did it sow the seeds of confusion?
If you don't understand it, don't worry. You don't need to.
Good.
But basically, this is an
That's why I asked a broad and generic one.
Yeah.
This is the Labor Department, the Bureau of Labor Statistics, weights the prices that go into CPI, and it has a higher weight on housing than anything else, about 33%, almost a third of the whole index. And one of the components of that, owner's equivalent rent, was weighted too high, they said in this email that went out to so-called super users, people who really dig into this stuff. Now they're sort of disowning this memo, but it wouldn't have as much of an effect on the PCE because the PCE weight is much smaller for housing than CPI. And so the bottom line is, we can look at the numbers, but this is sort of a statistical nerd issue.
If it's a statistical nerd issue, then the place for it is obviously here on Bloomberg TV, because I don't know where else you're going to talk about something like that. So, Mike, okay, we got PCE today. We had CPI and PPI already. We're getting this picture being built. So when the Fed is looking at PCE today and thinking also about the next CPI, how important is its weighting? We know it's the Fed's favorite gauge, but how much does it matter considering the succession of data we've been getting?
Well, it's interesting because the next CPI is probably going to matter more than the PCE, even though the PCE is the Fed's target indicator, because it'll be the freshest data when they meet on March 20th. They've already told us they're not going to do anything in March, so today's data isn't going to influence that. But in terms of their thinking and what they end up telling us about the May meeting and maybe the June meeting and how many overall cuts they're going to make, the CPI could have a greater influence because it's going to be fresher data. And if it shows a rise in inflation, again, that'll worry the Fed. It won't be on a percentage basis as much for the PCE, but it will be a sign that it's going in the wrong direction, and that's what they don't want to see.
I see. So it still could be exciting, Mike, is what you're saying.
It still could be exciting. You tune in. You cannot miss this. I was thinking, if you make it a horror movie kind of thing, this Pogo problem from, the call is coming from inside the house.
Right. I can't wait to see the horror movie unveil itself with you on air at 8:30 a.m., Mike. Stick around for that. Bloomberg's Michael McKee, thanks so much. Okay, let's talk a little bit about tech. Shares of Snowflake are sinking in the pre-market trade. The software maker delivered a disappointing sales forecast and announced that CEO Frank Slootman is stepping down. Joining us now is Bloomberg's Alex Webb. Alex, I remember when this thing IPO'd, everyone was so excited about it. Here you have this cloud play and everyone rushed into it. What was the change? What's different now?
I think it's something we're seeing that with so many tech companies, particularly those who seem to have a little bit of AI exposure, expectations are colossally high. Snowflake's trading at something like 220 times its 12-month forward earnings. Even on a 3-year projection, it's trading at like 99 times its forward earnings. So any sort of wrinkle that it comes in below expectations, and it's likely to be punished. The thing that we've seen actually in terms of its business is that companies aren't spending quite as much on software as they tried to cut costs. That's been the case over the past 12 months or so. Where they are spending is in artificial intelligence. Now, Snowflake does have some things that can help with that. They provide the sort of ways of storing your data that perhaps AI can use, but they haven't really seen that business come through yet. Analysts do expect it to come at some stage in the future. At the same time, obviously, the stepping down of the CEO, the departure of the CEO, is something the market hasn't taken brilliantly, and a combination of those two factors, you see that big stock decline.
So if I look then at Salesforce, again, very much in the software business, very much in the customer, the front end, the dividend that they've delivered for us, I mean, it's the juxtaposition between the dividend and the outlook on sales. So is it the similar kind of story for them?
There's a similar story in the sense that Salesforce also doesn't yet have that big AI exposure. It's trying rapidly to come up with some products to do that. It's introduced a few things in recent months, but it actually is symptomatic of the broader trend we're seeing within tech, that namely, there isn't the sort of massive growth that we had before. That means instead there's a focus on the bottom line, and that is what Salesforce is delivering now. In previous years, they had very little in the way of earnings. They've gone from, sort of sub $1 billion or sometimes loss-making years on a net basis to likely to have $9 billion of earnings, again on a net basis, at the end of 2025. So it's a massive pivot, which means therefore the slightly slower growth on the top line, as long as the improvement on the bottom line is still there, the news isn't, so investors aren't taking the news quite as badly.
Yeah, well, of course, the margins are a little bit better over at Salesforce, and they've already announced cuts of 700 jobs. Alex, thank you very much. Alex Webb there with the very latest on all things tech. So we've got a big one for you now, Danny, haven't we? It is all about the fundraising and deal-making in tech.
Yeah, we're going to be speaking with EQT's head of North American private equity, Eric Liu. That's on deck next year on Bloomberg Brief.
Ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on that folks are so excited about it. Climate tech is the hottest area to be in.
Sports and money, they've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
It's Bloomberg Brief. I'm Danny Berger alongside Manish Cranny in New York. Now, we got some private equity news for you. It has been a difficult market for fundraising out there, but not for all. EQT, the third largest PE firm in the world based on funds raised, has just raised a lot more. It's raised $24 billion for its largest ever private equity fund. Pleased to say joining us now is Eric Liu, head of North American private equity at EQT. Eric, I feel like those numbers don't even do it justice. Just so our viewers know, this is 40% bigger than your prior fund, your largest ever, $4 billion away from being the largest fund raised ever. I mean, we had it in the intro there. It's been said that this is one of the most difficult environments for fundraising. So are the people that say that wrong?
No, I think it's been a pretty difficult environment in the past few years. There's not been as much liquidity that's come back to limited partners. And so I think their ability to deploy new capital in private equity funds has been more limited.
So what's the secret sauce then? How are you able to do that? I mean, the stats I have here, Raymond James says that in 2023, private equity returned the lowest amount of cash to investors since the great financial crisis. So how do you raise a record fund in that environment?
Yeah, so we're really pleased with this outcome. I would say there's really three things that led to this outcome for us. The first is performance. I think performance really matters in all markets, but particularly in markets that are a little bit more choppy. I think we've demonstrated the ability to generate performance across all sectors and geographies in which we operate. I think the second thing is our differentiated approach to investing. I think relative to other, some more traditional private equity firms, the way we invest and how we interact with our companies is quite a bit different, and I think that matters. And the third thing also is that our limited partners, we've been around for 30 years as a firm.
Right.
A lot of the institutional investors that invested in our fund have been with us for a very long time. They're quite loyal to us as a firm. We treat them as partners, and they view us as partners as well, and they want to see us successful.
I mean, Danny and I, we were chatting about this discussion with you this morning, and the one thing we want to understand is there's this gap, the gap between the buyers who don't really want to pay up because they're potentially facing a recession. I mean, this is between the gap between the buyers and the sellers who paid a lot for assets, but they don't want to sell at a loss. I mean, are we reaching an inflection point of where there's a break in that? Is there are you coming closer together? Yeah. Is the marriage getting better?
Yes, I think it depends on the company. So if you look at it, in any market, there's always going to be a gap between buyers and sellers at some point until the transaction occurs. I think what's happened in the past years as valuations increased really almost nonstop between 2021 and kind of middle of 2022 for a given asset. You know, people paid quite a lot for, you know, the same asset they would have a few years earlier. But for the really good companies, particularly ones that are growing, they can grow into their valuations over time. And so maybe the average holding period for a private equity investment prior to, let's say, 2011 might have been 5 years. In the last few years, it had really shrunk. You could hold assets for 2, 3, and 4 years and still achieve your targeted rate of return. I think what we're seeing now is it's going back to being slightly longer holding periods in order to deliver the multiple of capital that you need on the same investment.
Could the gap also be solved, though, with valuations coming down? Because that's one of the things you said is valuations were higher and that made this difficult. Could that be the solution? And is that likely that we do see a period, be it recession, be it macro stress, that valuations come under pressure?
Yeah, it's funny. It's a little bit like the real estate market, right? So let's pretend you have a whole bunch of houses on the same street. People always remember what their neighbor's house sold for. And so if they don't have to sell, they'll just sit on it. And so what we've seen is that the buyer-seller gap, it doesn't close. It just, you see fewer transactions. But over time, as companies grow into them, then the companies will.
I was worried about that metaphor because people are worried about commercial real estate right now. I was like, where are you going with this, Eric?
Where are you going with this fund? Because we spend every day on here talking about AI and Magnificent Seven, and there are other things in the world. But I'm curious, and again, the debate is where do you deploy, and avoiding AI or not having it as an integral part is perhaps the biggest risk of all. And the debate that we were having before we came up, which was, would you buy a pure AI investment with this new fund? Or how's it going to play out?
Yeah, so this particular fund, and we have a number of different investment vehicles at the firm. This particular fund is our large cap buyout fund. So we're buying mature cash flow positive companies. Like, we wouldn't invest in a pure AI tech company in this fund. Maybe our venture capital fund would. The thing that we focus on in this fund is, for the portfolio companies that we have, is AI a benefit or a threat? And how do we make sure that we take advantage of the technology to make our companies as valuable as possible?
Now, our deals team reported the other day that you were looking at IPOing Galderma. We're in this moment where stocks are at an all-time high, and we can argue whether that's fundamental or whether that is just 7 stocks. But do those all-time highs make the IPO environment more attractive? Is this the market window now to exit in that way?
Yeah, I can't comment on Galderma specifically, but I would say the IPO market generally, it's a little bit different than the overall equity market. Overall equity markets are obviously at all-time highs right now, but it's very dominated by those 7 stocks that you mentioned earlier. If it's not one of the 7, the market's a little bit thinner than what we've seen. And so in order to take a company public, you want to see the company not only price well, but also trade well in the aftermarket. And I think you need to see those conditions exist in order for the IPO market to come back.
Danny gave us the data. I'm curious to know where you went in terms of the core raising in this fund, because the whole world is traveling to Abu Dhabi, Dubai, and to Riyadh. So what can you tell us in terms of the proclivity for those sovereign wealth funds to participate in this new fund with you? And to what extent are they still the key deliverers of liquidity at this moment in time?
Yes, our investor base is comprised of pension funds, sovereign wealth funds, different types of financial institutions. The base has been pretty consistent over time. I mean, a lot of the sovereign wealth funds that we have invested in our firm increased their commitments between the prior fund and this fund, which is why our fund has increased in size. But the
Did you see a more significant participation from the Middle East?
I think we've had fairly consistent participation over time across the different geographies. The thing that's new in this fund is the contribution from private wealth. That's an area that's a huge focus for us going forward, because I think that'll be a bigger part of the fundraisers as we try to scale our future funds.
I mean, the big picture thing here is that you've just seen huge growth. When you IPO'd in 2019, 41 billion euros under management. Now it's 232 billion euros under management. I mean, you're putting up numbers like Blackstone and KKR, and for long the criticism of them has been, oh, it's this commoditization of private equity. The creativity is gone because you're so large. So what happens to EQT now that you're so large? How do things necessarily need to change when you have over 200 billion euros under management?
Yeah, so the firm itself has 200 billion euros under management, but for the individual funds and the individual partners who are deploying it, we've been deploying capital at scale for years. I mean, even back when I joined the firm 10 years ago, we were doing some of the larger deals in the market. And so the size of deals, the sectors we're investing in, the value creation strategies have been pretty consistent over time. And so the scale of the overall enterprise doesn't really impact the amount of creativity and the value creation strategies we have to deploy in the individual assets that we're acquiring.
Let's sort of circle back and finish off with these markets and the impact that it has on flow to your world. When you see these record highs and this kind of frenzy, mania, euphoria, choose your word, whichever one you want, I just get the sense that there's more of a reason then for you to present to me as a potential customer. Are you finding it easier in this frenetic public market to deliver a cogent story on why I should participate in private equity?
Yeah, so I think, as I mentioned earlier, I think the sort of frenzy is sort of confined to a part of the universe that maybe we don't interact with every day.
I get that.
But for the private wealth, for example, are these people who would have been in the public markets and say, I don't like what's going on here, I'm going to look towards private?
Yeah, I think as you think about how our asset class has developed, you know, people own real estate, they own bonds, they own stock. But I think particularly for high net wealth investors, having a percentage of their assets in illiquid assets like private equity is a great part of the portfolio. And because our asset class has matured and because our company is now more well-known, it's easier for people to take the decision to invest in a firm like EQT.
Eric, thank you very much for making the trip in, and that is a monster raising. So well done. Congratulations to everybody there on the size and the scale. Our guest this morning, that is Eric Liu of EQT. There you go. Private wealth managers of the world, you know who to call, and you know where to get a hold of it. A little piece of private equity. Good morning from New York.
Let's go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom, okay? It's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with the plan.
Our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
This is Bloomberg Brief. I'm Danny Berger with Manish Cranny in New York. Okay, let's get you set up for your trading day. Here's a look at what's ahead. We're going to get US PCE, a key inflation indicator, and another round of jobless claims at 8:30 a.m. Then throughout the day, Fed speakers, including Austin Goolsbee, Loretta Messer, on the back of that data. Then more earnings, Best Buy before the bell, and Dell reporting after the bell. Manis, what you got for those individual stocks?
I got some rocking stocks for you this morning, Danny. Snowflake plummets, the CEO shake-up, and you've also got sales missing the forecasts. HPE reports sales that miss with the PC slump dragging on that. But wow, this is the power of Oprah. She's leaving the board of Weight Watchers, and the company is struggling to stay relevant in an era of Ozempic. 23%. That is the power. She joined the board, what, in 2015? So
yeah, and that was hugely helpful to Weight Watchers. People say Warren Buffett moves stocks. Oprah Winfrey does. That's real power there.
The real power. Weight Watchers. Keep an eye on it. Surveillance is up next, and it is PCE Day. Good morning.
venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
DOJ or other authorities
could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Really what's happened in the bond market is it looks like the market got ahead of itself.
We had that stronger January jobs number, which I think is what really kicked off this readjustment in market expectations.
You look at what the Fed is just continuing to tell us, data dependency, and we are watching that data.
The data can switch quite rapidly, which in turn can have a rapid effect on financial conditions.
At least on the rate side, we really haven't broken enough yet to do the damage that everybody thinks.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning. Good morning. For our audience worldwide, this is Bloomberg Surveillance alongside Lisa Abramowitz together with Anne-Marie Hordern. I'm Jonathan Farrow. Your equity market on the S&P 500 down yesterday just a touch, down this morning by a third of 1%. You know the data over the last few weeks, CPI, upside surprise, PPI, upside surprise, PCE, Lisa, coming a little later.
Yeah, 2.5 hours away, and a lot of people are saying that's the big data point, but how do you really trade it in a market that seems to be driven by its own sentiment right now? And that seems to be what the lack of conviction that I've read in all of the notes overnight. I have to say, Stuart Kaiser had the headline of the day, frankly. Is Momo, FOMO, or ONO? And talked about potentially shorting small caps if PCE is surprised.
You can translate that later in the program, but ultimately, over the last few weeks, the last 2 months, this market has repriced aggressively what it thinks the Fed is going to do so far this year, and the Fed hasn't had to adjust at all. President Williams sounds like the President Williams we heard about a month ago.
Basically, 3 times seems about right for Fed rate cuts this year. They haven't changed their message. The market, kicking and screaming, came along to their view. But here's the real question. Is the market consistently pricing in a much slower path of rate cuts right now? Are we consistently pricing in still a complete nirvana soft landing?
Yep.
Or are people starting to think about what it means if an economy is not slowing down with 5.5% benchmark rates?
I can tell you the message has changed in Washington, D.C. There was a man back in the 1990s who once said, it's the economy, stupid. Well, it's not the 1990s anymore, and it's not just about the economy, stupid. Immigration is coming up as the big concern in swing states. AMH, in 2024, every state is a border state.
Well, exactly, but you're seeing pressure even from blue states on this White House to do more when it comes to the southern border. President Biden will be at the southern border today, as well as former President Donald Trump. Both are trying to also lean into this because look at this right now. Our poll shows more respondents are starting to track immigration as their top issue. Still, the economy remains front and center, but immigration is going to be one that they really need to grapple with. 1 point on the economy from our poll. Perception of the economy has actually done better. 31% of swing state voters say the national economy is heading in the right direction. That is up from our previous polls. The big problem is they're not giving the president credit for how they are feeling about the prospects of the economy, even if they think it's getting better.
Are they going to be at the same place at the border?
No, 300 miles apart.
They're going to be, okay, that's very
Well, it's going to be
specific.
two Secret Service. I mean, you know, if you look at how presidents travel, we're lucky they're going to be far apart for a lot of reasons.
I mean, honestly, the reason why I ask is just because I wonder how far apart their messages are going to be, or whether they're going to ultimately be the same message, just couched in very different language.
The interesting thing about our poll this morning is the issue of age, and we could talk about this a little bit later. 82% say that Biden is too old, 51% say that Trump is too old. That's a 4-year age gap that needs to explain somehow a 30-point spread between the two things. It's pretty amazing.
You know, we can get into this, and we can get into this with respect to the doctor's notes that we got from President Biden as well, which basically said not a lot and placated absolutely no one. And there's this real question here about whether it's just visibility, about whether we're just seeing Biden much more than we're seeing Trump, and whether Trump is more energized, or whether there actually is some sort of cognitive differential that people are trying to get their hands around. I can't weigh in on that, but there is a perception gap that Biden has to climb.
I find it interesting that President Biden yesterday was at Walter Reed. His physician said he's fit for duty, robust, 81-year-old. Yet, when you heard from the special counsel report, they said he was an older man. So it felt like this physician was almost pushing back on the special counsel report. And whether it's foreign policy, the southern border, the economy, this is going to be the trickiest for the campaign to overcome.
I hope that I'm going to be a robust 81-year-old as well, don't you? Equity futures on the S&P 500, negative here by 0.25%. Here's the stage. This is how we're set up going into that PCE data a little bit later on this morning. We're down 0.25% on the S&P. Yields are higher by 4 basis points on a 10-year, 430 on a 10-year this morning, 430.53. And the euro doing not a whole lot, 108.39 on euro dollar. Coming up this hour, Marvin Lowe of State Street as US stocks and Treasury yields ease ahead of today's inflation data. John Lieber of Eurasia Group as President Biden and Donald Trump hold dueling events at the southern border, and US Trade Representative Catherine Tai on tensions between the world's two largest economies. We begin with our top story, the US stock rally on pause ahead of core PCE data due at 8:30 a.m. Marvin Lowe of State Street warning we could be in a higher for longer world, saying, quote, if a no landing is the case, the Fed should be addressing a structurally different economy, and investors need to consider higher term premiums and higher long yields than what prevailed before the pandemic. Marvin Lowe joins us now for more. Marvin, before we jump deep into that, let's just talk about what you're expecting at 8:30 Eastern Time.
Yeah, sure. I mean, the numbers certainly going to move in a different direction than what we saw at the end of last year. You know, for the most part, PCE is a combination of PPI and CPI, so it's going to come in somewhere in that, you know, hot spot 3 to spot 4 type of number. The market's priced it, but it's really going to resolve nothing in terms of those that think that we're going to be potentially facing inflation concerns as we go into the summer, to those thinking that it's just a one data point type of blip. So we're not really going to solve anything. We're not really going to break through many of the ranges that we've been in for really the last 6 weeks at this point.
Marvin, there was a big disconnect to start the year between what the market was priced for and what was implied in the Fed's dot plot and what they were looking to do in 2024. We've closed that gap aggressively in the last 2 months. What's the big disconnect that you've got your eye on right now?
Yeah, I mean, the big disconnect at this point still is that once we start cutting, we're going to cut aggressively towards a normalized world that looks a bit like it did before the pandemic. You know, ultimately, a neutral rate somewhere around 2.5%, and this glide to disinflation, whether it's on the services side of things and certainly on the good side of things, which has been deflation, is going to reestablish itself at least at the second half of the year. There is a sanguine view that, you know, rate cuts, once they begin, are going to just continue in earnest because things are returning back to normal.
Okay, Marvin, all of this is very confusing and difficult. Add in a complete lack of trust in the actual data, right? I mean, yesterday, what was this coming out from the U.S. Labor Department, the story that Bloomberg broke about these letters sent to super users of the data, basically having this: the waits for single-family detached homes increased materially from December 2023 to January 2024. Nothing else is going to be said. Go on. And then they tried to retract it. What does this mean to you?
So I'm not a super user. I didn't get that. I didn't get that email. So I read it from Bloomberg myself. Probably the most contentious number within CPI is this owner-occupied number. It's an attempt to try to figure out what inflation is for those of us that own a home. There was a change in the weights between single family and multifamily, with multifamily being under more pressure, and all of us that watch the single family world or are trying to buy a house realize that inflation hasn't come down. We've always struggled with how to interpret that number. What this says to me is that you've got this bifurcation within just how to calculate it. That's not changing because the housing market still remains high. If that confusion continues out there, that inflation confusion is going to remain out there. And ultimately, we price CPI based on this very heavy weight. It should argue that we get more inflation volatility, which really, if you expect inflation to guide down to this really stable type of number, it might be a little bit optimistic.
Given that, you talk about a world in which 5.5% is not a restrictive rate, and the potential for that, which is something that very few people are thinking about. How much likelier is that right now than it was, say, 6 months ago, in your view?
You know what? It was always out there. It was whether or not you wanted to go down that thought process. The goods deflation that we saw in the second half of the year, maybe the fourth quarter, made everything look great. But we always knew that that services number, which is the biggest part of the economy, wasn't responding as aggressively. You know, we've got some decent prints coming out of ECI, but overall service inflation remains fairly high. And we've got a disconnect between what the jobs numbers are saying, the official monthly numbers, which continue to look pretty, pretty robust, as well as these weekly numbers, and the view that all of a sudden the jobs market is going to get right-sized. So within the next, 3 to 6 months, we're going to get a sense of really how much of the structural change in the employment market has a long-lasting effect, and whether or not we've got to think about higher yield, more inflation, volatility, more term premium, because the economy could be very different where it is now than where it was back in 2019.
Marvin, is that the case? If that's the case in the future, what would you do with equities right now?
Yeah, you know what? And I've said it, and I've said it often, despite kind of the duration argument. Growth in an economy that's for the most part aging is going to be a very attractive part of your portfolio. So those Mag 7s do have a moat that they can defend. But cash flow positive companies are something that wind up being somewhat attractive if yields ultimately remain higher.
Does this mean that basically the government bond market is a no-go, and if you want to hedge, just go to Bitcoin?
I'm certainly not a Bitcoin fanboy, so I'll leave that one out there. The treasuries continue to have volatility, particularly long end in my mind. You play it from a hedge perspective. We talk to customers about curve trades and things like that. Looking at 2s 5s maybe rather than 2s 10s. It's that type of nuanced world for me right now.
That's how you dodge the Bitcoin chat. Marvin, thank you. Marvin Lowe of State Street, appreciate it. We can talk about Bitcoin. The inflows into the BlackRock ETF have been absolutely phenomenal. I think it was $520 million the other day, which was a record.
And we heard yesterday fund managers saying that the way that they hedge is with cash and Bitcoin, and that's why you're seeing it surge to new records. I do want to point out there was this small little story on the Bloomberg yesterday talking about how leverage in crypto assets is surging again, including in NFTs, including in Bitcoin. So, it's, I don't know, deja vu all over again.
We're doing the NFT thing all over again, just short of 63K on Bitcoin. Plenty of Bitcoin checks through this morning, maybe a few, 2, 1 more, I don't know. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. An Illinois judge has barred Donald Trump from appearing on the primary ballot. It's the third state to impose the ban for Trump's role in the January 6th insurrection. Trump now has until Friday to appeal, and he's already appealing a similar Colorado ruling before the U.S. Supreme Court. Weight Watchers shares are falling a lot. 23%. Oprah Winfrey said she would leave the company's board if shares continue to fall. The stock is set to hit its lowest level on record. Winfrey's departure is just the latest blow. Weight Watchers is trying to stay relevant in the Ozempic era. The influential talk show host says she will continue to work with the company in, quote, elevating the conversation around obesity. She served on the board since she struck a deal with Weight Watchers in 2015. Shares of Paramount, on the other hand, are rising 4.25% in the pre-market. The company predicted, quote, significant earnings growth this year that helped investors overlook a 6% sales drop as a result of shrinking ad revenue on traditional TV channels. The company also saw subscriber growth beat estimates on its Paramount Plus streaming service, which it expects to be profitable at least domestically, next year. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. Up next on this program, Biden and Trump's border showdown.
Donald Trump. He'd rather weaponize this issue than actually solve it.
With 4 more years of Biden, the hordes of illegal aliens stampeding across our borders will exceed 40 to 50 million people.
That conversation up next, live from New York City this morning. Good morning.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. It's a huge week ahead in politics. On March 5th, it's Super Tuesday, and former President Trump is looking to cement his place as the Republican nominee. Then, 2 days later, as the border, the economy, and the November elections dominate the headlines, President Biden will deliver his State of the Union address. Balance of Power's Joe Matthew, Kaylee Lines, and Bloomberg's top political analysts will bring you live global coverage of both events, starting Tuesday, March 5th. Bloomberg. Context changes everything.
Inflation data just around the corner. Equities pulling back by 0.2% on the S&P 500. Treasury's a little softer. Yields a bit higher at 4 basis points on a 10-year, 430.73. Under surveillance this morning, Biden and Trump's border showdown.
All indications are this bill won't even move forward to the Senate floor. Why? A simple reason. Donald Trump. He'd rather weaponize this issue than actually solve it.
With 4 more years of Biden, the hordes of illegal aliens stampeding across our borders will exceed 40 to 50 million people. Medicare, Social Security, health care, and public education will buckle and collapse.
Here's the latest this morning. President Biden and Donald Trump hitting the campaign trail, planning dueling trips to the U.S.-Mexico border. Immigration gaining ground on the economy as a top issue in the latest Bloomberg Morning Consult poll. Meanwhile, Trump maintaining his lead over Biden across all 7 swing states. John Lieber of Eurasia Group and former policy advisor to Senator Mitch McConnell joins us now for more. John, wonderful to hear from you, sir. It always is. Can you frame for us how different these addresses might be a little bit later today from these 2 leaders?
Well, you just saw a great preview of it. I mean, Trump's talking about tens of millions of people coming across the southern border, not a particularly realistic number. But Biden's on the defensive here, and this is a huge issue in the campaign this year. And migration numbers have been very bad under his watch from the perspective of people coming over the border. And I think he's going to be on the defensive the entire year. Plus, he's got to worry about this continued split in his own coalition from some Democrats who think the Republican approach is inhumane, and independent voters who want to see the U.S. government do something about the flow of illegal migrants. So this is a huge opportunity for President Trump, former President Trump. It's one of the reasons he won in 2016. And if Biden can't change the narrative here, he's going to be in even more trouble than he is today.
Well, to change the narrative, he might use an executive order. We know the White House was weighing this. Do you think before the election they will come out with some sort of executive order on the border?
Yeah, I think they're going to have to. I don't know how they don't. I mean, one opportunity, the politics of an executive order are quite good. It doesn't necessarily do much to change what's actually happening on the ground. He's not going to do the kind of things that Trump did. It allows him to draw attention to what he just did in that clip, which is point out that Republicans had a chance to get a border deal and turned it down because of politics. So he's trying to flip the narrative by taking action, whether or not it's effective, is something that's going to help him politically.
Well, our polling shows that respondents still think Biden is responsible for the border, but more people are starting to also lay blame on Republicans in Congress and the Trump administration. So do you think Biden has, between now and November, able to close that gap and put more of the blame on Republicans for tanking that border deal?
No, I think those are kind of inside baseball arguments, and inside baseball arguments just don't really land with voters that much. I mean, he's basically making a process case that, I had a bill and the Republicans stopped it. And, the incumbent president bears the blame for what's going on in the economy and in society. And he's going to have to bear that blame, even if Republicans do have a role in that.
You, of course, worked for Senator Mitch McConnell. Yesterday, he said he's backing down from his leadership position. The president came out with a very friendly, nice response about him, talking about their time that they've worked together, about American democracy based on elected representatives coming together, bridging their different points. Is this part of our politics over, seeing McConnell step aside?
Yeah, I mean, this is the passing of the torch to the next generation, and the next generation is a lot more aggressive, a lot more confrontational, and a lot less willing and able to get things done than retiring Senator than Leader Mitch McConnell. And I think that's a real shame for the country, because McConnell's whole thing, his entire time in office, is how does he drive to put wins on the board and get to yes. And that is not an attitude you see among a younger generation of lawmakers who come to Washington either to start trouble or to make statements in order to help their own political ambitions. And McConnell's only ambition was to become leader and then start doing things for the American people. And I think that outlook is a really, unfortunately, outdated perspective.
John, from here until the end of the year, does Mitch McConnell have more or less power now that he's announced his departure date?
Yeah, I mean, I hate to say it, but I think that's the wrong question. I just don't think that there's anything going to be happening between here and the end of the year, right? McConnell's big accomplishment is going to be passing the Ukraine aid bill through the Senate. That's done already. Maybe, they'll get a government funding deal. They'll have to deal with shutting down the government again later this year. The Ukraine question is all on the shoulders of Speaker Mike Johnson. So, McConnell's announcement yesterday just recognizes the reality that 2024 is not going to be a particularly active year in the United States Congress.
The reason why I ask this is because some people are speculating what role the former President Trump is going to have in picking a new leader for the Senate. What's your view on that at a time where a lot of people are talking about the slew of Johns, different senators with the name John, that could potentially rise to the helm, who are not necessarily on the more extreme fringes?
Yeah, Trump's role here is going to be massive. I mean, if he's the president of the United States, if he's the president-elect of the United States in November of this year, he will select the next leader. He will be the most important person in the party. He will be the dominant leader in the party. If he's not, it's a very different situation. And that's where you probably see the dynamics among the Johns that you're talking about, who have been kind of vying to succeed McConnell for quite some time, playing out. But if Trump's in there, you can have a pretty broad range of outcomes. I mean, I think there's another generation of leaders, of potential leaders in the Senate, who are not today in leadership positions, who are going to be vying to be Trump's person inside the United States Senate. And the range of outcomes here is quite wide. I don't think it's really early to handicap the succession race.
John, forgive me, because we've only got 4 minutes left with you, and this is quite a large question. But what is the ideology of the Republican Party under former President Donald Trump? What is it anymore?
I mean, this is a populist, conservative, right-wing movement that unified behind a quasi-personality cult of Donald Trump. I don't know how else you think about it. The goal of the party is to win back the White House. The guy who's going to win back the White House is Donald Trump. He has pushed the party in very uncomfortable directions that basically most elected officials are now comfortable with. For example, the party's hard right, or I don't know what to call it, the party's populist turn against international trade. And that's who they are right now.
Not just international trade, against mergers and acquisitions. We used to kind of characterize the party as being somehow business friendly. We speak to some analysts now who suggest that maybe they're not. John, we spoke to Speaker McCarthy in the last month or so, and I tried to address this question with him, and he didn't really answer it, about whether his party has just left him behind. We caught up with Nikki Haley in the last month as well. I just got the same feeling that this isn't her party anymore. It's different, it's changed, and maybe it's not turning around anytime soon, which begs the question, John, when I speak to my friends, traditional conservatives, old school Republicans, they kind of want another party. What are the chances that we get one?
None. I mean, the U.S. system has built itself around two major political parties. There's a lot of kind of social science reasons for that, and there's structural reasons for that. It's very difficult for independent candidates to even get on the ballot. And third parties just don't have the, Coke versus Pepsi brand appeal of the Republicans and the Democrats. It's why there's no independent or third party governors in this country right now. So, the Republican Party is moving in a very populist direction on trade, on labor issues, on immigration. And that's who they're going to be for at least the next 5 to 10 years before a new leader comes along to force a new political realignment, which is not on the horizon right now.
John, forgive me for asking this, because I know over the years you've been close with Senator McConnell. Do you think it's a failure of leadership beyond former President Donald Trump that they weren't able to make their message, their policies that much more popular within the party and ultimately for the electorate as well?
Yeah, I mean, this is a democracy, and the voters ultimately decide what they want, and what they want is Donald Trump. And you can blame that on failure of messaging, but the fact of the matter is that the Republican commitment to international trade has had implications in communities across this country that have been pretty devastating. And I think that there are costs associated with a lot of the policies associated with the Bush years of the Republican Party, and those costs have come back now in the political system, and that's where we are.
John, appreciate that reflection, sir. Thanks for catching up with us. John Lieber there, of Eurasia Group. I think for the people who are hopeful that we get that third party, it's just not happening.
I'm glad you brought that up, though, because in our polling, RFK is starting to be now more well-known. He rates very popular, most so among conservatives and Republicans, and this was the numbers. Among the so-called double haters, the people who don't want to see Trump or Biden, his favorability rating has improved from 25% when we started this in October to 45%. So if he's on the ballot, he's going to be pulling from both of these candidates.
I think people in the middle just resent what's happening right now, because people who are centre-right feel like the extreme left is pushing them further right, a place they don't want to be. People centre-left feel like the people who are far-right are pushing them further left. It's a place they don't want to be. Seems to be the extremes of the two parties, Bramo, which are shaping the politics of this whole country.
Which is the reason why I'm curious about the money. I'm curious about where the money from businesses is really going to go at a time where no one's getting particularly excited for this particular election.
It's hard to get excited for a lot of people. And you see that in the polling, by the way, repeatedly. Coming up on this programme, would you believe it? Chinese equities, just looking at the CSI 300 on my screen right now, up by 9% this month. This month alone, for February. We're talking about that with Virginie Maisonneuve of Allianz up next.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West, only on Bloomberg Television. Context changes everything.
Stocks on the S&P 500, negative 0.25%. The big data point, PCE, about 2 hours away. Going into it, stocks pulling back by 0.2% on the Nasdaq 100. Some slight, subtle, mild outperformance on the Russell. The small caps up by 0.15. In the bond market, 2-year, 10-year, 30-year. The 2-year still in and around 470, 468. Yields picking up here across the curve going into this data. We're up by 4 basis points on a 2-year. Lisa, 4 basis points on 10s.
The expectation is that it's likely to come in hot. And what I keep seeing is if it comes in at 0.3 to 0.4% month over month, this core PCE metric, that's not going to be good for the Fed. They are not going to like that. And that essentially in March is when it starts to get less noisy with the year-over-year comps, and it becomes a much more inflationary picture potentially if this pressure retains.
Hasn't been good news for the 2-year Treasury either. Let's put it that way. I mean, look at the low and look at the high. On the yield, 4.1% last month, the high, 470 earlier this month.
Are we seeing stocks wake up to that?
Nope.
Okay, so this is really my question. Why are they treading water right now? Is it just because no one can get particularly enthusiastic and all the stories have been told? Is it because people are actually short, or is it because nobody has any conviction whatsoever, so they're just going to basically sit there and go like this until they can figure out what more is happening?
Are they sleeping on higher rates, or are they wide awake to the reality of what got them here?
They're wide awake.
Better data?
Yeah, exactly. And better earnings, right? So that's really what seems to be driving everything that we're seeing with respect to the confidence in equities.
2-year 468. Let's finish on foreign exchange. Want to look at dollar yen. The charts that we close at 150 at below 149.98. We have not had a close below 150, I think, in about 2 weeks. We're negative 0.5%. So what you see on the screen right now is a stronger Japanese yen off the back of some commentary from a BOJ board member who gave a subtle hint, with the emphasis on subtle, that maybe they'll move away and start hiking interest rates.
It's never too subtle to get excited about the potential for moving away from negative rates. This is the comment. The Bank of Japan's price target is, quote, finally coming into sight. All right, they're going to hike. They're going to hike in March, right? I mean, this is basically where the market goes with that kind of commentary based on the fact that they've been so tepid on any kind of guidance whatsoever.
Off the back of that, just a little bit of a break at 150, 149.99. I'm trying to inject a little bit of excitement here.
People are excited, but, it's not translating.
We did Bitcoin a little bit earlier.
Super excited.
That rally's been phenomenal, amazing. Typically, you'd say the ETF news would be a Southern news event, and I know lots of people said that. That has not been a Southern news event at all.
Yeah, but I don't really even have an understanding of what this is. How much is this just that people don't have a diversifier because it's not bonds anymore? I mean, we heard that yesterday. I think Jonathan Stubbs was saying that, right?
Talks
that
about
basically
that, yeah.
Bitcoin is one of his assets that are uncorrelated to the rest of the market. I don't know what they're correlated to, maybe leverage going up in this area. But to me, this sort of popped out of nowhere and seems to be on a freight train, moving back to some of the hodls and other types of trading.
Nice. That train just went through station 63K on the screen right now. You like that? No. Under surveillance this morning, investors are waiting the Fed's preferred inflation gauge, core PCE, due out at 8:30. The dad jokes are terrible at the moment.
I love it.
I know, I'm sorry.
Keep going.
Bloomberg survey expecting the number to double from a month earlier to 0.4%, plus another look at the US consumer with personal income and spending data. Then 210K, the estimate for jobless claims. Fed speak also on deck throughout the day. We'll hear from Presidents Bostic, Goolsbee, Mester, and Williams. Claims. I think claims are going to be super, super important important, given how low claims have been over the last few weeks.
And how strange it is that we keep getting notices from different companies about layoffs. I mean, we've heard this from company after company, whether it's Bumble, whether it's some of the bigger companies that came out yesterday. We saw some issues with Salesforce. We're seeing something with respect to guidance from HP. You know, all of these companies are, and Snowflake we saw come in quite significantly. They're all of these companies that keep trimming jobs. Why are they not showing up in the numbers, and do we start to see that?
Sony, Macy's, it's across the board. The Conference Board data shows that actually consumers are now very concerned with the labor market more than they've have been. It was always about inflation. Now they're also worried about job prospects. So that's something that I think you're right, for jobless claims is important. Are we going to at some point see any cracks?
Andrew Hollenhorst of Citi suggesting that maybe claims have been a little bit misleading and taken our attention away from the weaknesses seeing elsewhere, specifically in retail sales. I'll share the quote with you all at home. Low initial jobless claims and previously stronger data support the consensus that for now activity is solid. We continue to see a soft landing as the least likely outcome and expect activity to weaken later this year. Next week's jobs report, 2 Fridays away, is a key test and we see downside risk.
Okay, I'm going to go on a rant. Everyone's saying, watch the data. Everyone says the data's going to tell us everything. And then they say the data's messy, it's wrong if it's weighting things differently. And oh yeah, it's completely misleading because you've got to look elsewhere at other data. It just creates the frustration of why we're sort of hitting our heads against the wall every time we hear someone come out
We're
and
only
say,
30 minutes in.
All right, carry on.
How riled up are you going to get? But I'm with you. Whenever they talk about data dependency, it would always wind me up because the real question was, what data are you dependent on?
Totally.
Like, we're all sort of data dependent to some degree, but how much weight do you put on one data point versus the other? And they never seem to go into the detail of any of that.
No, and when they do, it's usually pretty vague and sort of, we'll see, we'll adjust, and guess what? We don't know.
If this is where Bramo's at 6:35, I look forward to 8:30 when that data actually drops. Here's the latest from Congress. Congressional leaders striking a deal to avoid a government shutdown. The deal extends funding for some government agencies a week to March 8th. The second deadline to fund departments, including Defense and Homeland Security, now sits at March 22nd. Hardline Republicans already condemning the agreement, setting up another fight with Speaker Mike Johnson. Are we done here, AMH? Are we moving on?
No, it feels like perennial shutdowns. We're moving on from this potential shutdown, but they just set up more dates where we can shut down. This is the 4th time since October that they voted on, or they're about to vote on, another continuing resolution. The issue here is going to be more in the politics, because Speaker Johnson is already getting a ton of flack from the hard rights saying, we didn't want to see another continuing resolution. You promised us you wouldn't have a continuing resolution. Ralph Norman last night said it was an insult to the American people. But yeah, the government will remain open and people will get their checks.
You're not fired up about this one?
No, I'm not.
Didn't
I'm
think
sorry. So. We'll leave that there.
Move on to this. The hits keep coming for Boeing. The Justice Department raising the possibility of criminal prosecution following last month's blowout aboard a Boeing 737 MAX jet. The probe stretching back to a deferred prosecution agreement after 2 fatal 737 MAX crashes back in 2021. The Alaska Air incident of January happened 2 days before the deal was set to expire. If prosecutors determined Boeing failed to comply, they could bring criminal charges, Lisa, against the company.
This is just more bad news, and we see the shares falling yet again. And this raises this question of what's going on at Boeing to really do a deep dive investigation into what went wrong culturally, and also what mishaps there were, what sort of oversights or negligence there was by some of their employees at a time where they're dealing with employee confidence, employee retention, all sorts of issues. I mean, it just sets up a whole number of questions I'd like to ask Brooke Sutherland.
TK did a fantastic job of this when this story first broke. The cultural issues inside the company. What's changed? We've seen some personnel movement, but ultimately, you're going to look to the top of this company a lot more over the next few weeks and months.
Especially given some of the commentary. What did they say? That it was unclear safety requirements, that they changed on a regular basis? That kind of confusion, not great.
The report commissioned by Congress that we got to look into talks about this, quote, disconnect between the factory floor and the C-suite. Brooke Sutherland has talked about this a lot of time. Issues that are going on the factory floor are not getting to the executives that are miles and miles away. And the FAA came out yesterday talking about some of this, but they stopped short of some of the harshest measures they could have had on Boeing, which would basically mean halting the production of 737s overnight. But this is a huge headache for not just Boeing, but also the FAA.
Boeing in the pre-market negative here by 0.7%. That's the latest for Boeing. Here's the latest over in China. Investors betting the government will do more to backstop the economy ahead of the National Party Congress next week. We've had a big rebound in stocks in China, helping to push equities in Asia to their best February since 2015. The CSI 300 up by more than 9%. Virginie Masseneuve at Allianz Global Investors saying the country is headed for the Great Reset. Virginie joins us now for more. Virginie, wonderful to hear from you because you've been constructive on this part of the world, and I struggle to find anyone else that has been. Can you tell us why, apart from the fact that this is really under-owned?
Yes, thank you. Listen, you have the headlines and you have the changes that are taking place in China, where President Xi Jinping is really building a common prosperity economy, and that's a new concept, really, given the demographic profile, given the development that China has achieved. This is something that is well understood. What has happened, however, given the volatility, is many foreigners have left the market, and actually over 90% of the domestic Asia market is now held by domestic investors. So I think in that context, any good news, any labeling, if you want, of the bad news is a source of a potential rally. We like innovation. We don't buy China as an ETF. We buy China as an active, if you want, a battleground where you find a lot of very interesting companies in green tech, in med tech, in tech, as you know, bifurcation of the world's standards, given the New World Order and what I call China Phase 3, means that a lot has to be rebuilt in China, and semiconductors, etc. There's a lot of super innovative and very interesting companies.
Virginie, how do you sort of shape your view on China with things like China's banning of certain types of trading, with their banning of certain quantitative traders who maybe do the wrong trade?
Yeah. So listen, it is an emerging market economy, and we know that some emerging markets have that uncertainty